we see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
One of the reasons Treasuries are so high compared to other parts of the bond market is simply there's such an enormous supply of Treasuries.
For all intents and purposes, there's a buyer strike in the Treasury market.
Obviously, we're focused on that 10-year. Right? The 10-year needs to stabilize. Everyone's watching that.
The fact that 10-year yields are higher, I think, is probably consistent with what the Fed is trying to achieve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Some calm after a bond market storm. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly softer, down 1/3% on the S&P. Best day of gain since mid-September on the S&P 500. Bonds, Tom, just settling down just a little bit, going into payrolls.
I'll go with that, but it's very fragile. We'll get into the data check right now. I'd say it's a calm, yes, but a fragile calm at best. After the festivities in Washington, the Matt Gates interview that Anne-Marie and Joe had yesterday, after the bond pieces are picked up. John, I've had time to look at a set of charts. I'm not going to bury you with them now or the details, but it's a Peter Pan economy. It is never, ever. I've never, ever seen some of these charts in any of my studies. They're not in Fibonacci. That we're in a bond land that's, Bob Michael or Steve Major would say it's never, ever.
So the Bloomberg team has done some fantastic work on the numbers. The price destruction we've seen on the long bond.
Exactly.
So bonds maturing in 10 years or more, some great numbers here, have slumped 46% since peaking in March 2020, according to data here at Bloomberg. Just shy of the 49% plunge in US stocks in the aftermath of the dot-com bust. So, Tom, you've been on top of this over the last couple of years. When the sell-off really got going, the destruction we've seen in bonds, almost as bad, by some measures worse, than what we saw in equities in the dot-com bust.
The timeline, and there's, again, there are a whole bunch of charts, a whole bunch of nations we can go to. Let's look at John Ferro and the 30-year gilt Ferro's loaded the boat on. That's worked out. The price takes you back, John, on a 30-year British bond, 1998. We're going back to 06 here. 05, 07, maybe 00. You're going all the way back to the great financial crisis. On radio, this is a very tough chart to see on the x-axis, but the answer is we are back to that financial crisis of 1998.
Do we need bad news to put a lid on this? Maybe, Bramo, we do. And maybe it's a ADP report that nobody cares about that sparks the big moves that we saw yesterday. Amazing to see, right?
It was amazing to see. The fact that Barclays came out and said that the one way to get a rally in the bond market is to see a crash in risk assets. This is essentially what it seems like is the prevailing thought, that essentially if things get bad enough in financial markets, it will get the Fed to reverse course on some level. It'll get a bid into bonds that just isn't there. And at a certain point, my real takeaway from this is there is a deep frustration at the resilience of stocks to some of the sell-off, because that would be the circuit breaker.
A lot of people are circling the word hope, saying, geez, I hope stocks go down. There's a lot of that going on this morning. But, to get out front of October 13th and on, I get it. Most banks will survive. They'll have VAR, they'll have risk, they'll have Red Nassim Taleb. I get it. Come on, there's got to be a couple people getting hammered right now.
Well, there are at the moment on the bank stocks, right? The Charter Bank of America.
But I mean on their balance sheets. I mean internally. I mean, you've got this wonderful conversation today with Mary Daly at the Economic Club of New York. I mean, not Mary Daly or any other Fed president or governor, but their staff. You don't think they're looking this morning at selected 200 banks?
My guess is that every morning they try to understand. Is it going to be a circuit breaker moment, though? Or is it going to be a slow grind that's a kind of boiling the frog moment where basically credit gets withdrawn from the economy, and then suddenly there's a wake-up moment where suddenly people realize this is a very different economic trajectory with a much worse outlook?
Don't use boiling the frogs with Mary Daly, because they have restaurants in San Francisco where you eat frogs.
Make frogs?
Yeah, you eat frogs.
Which restaurant would that be?
I don't know. I've been at them.
I've
looked at the menu and said, are you kidding me?
Can I call you out? Actually, you started out by John saying it looks a little better. You said, just wait. What is this? Gloomy Tom?
It's the both of you, apparently. It's 2 against 1.
If you line up an N, okay, take a statistical N, okay, take 30 banks in whatever category. Guess what? 29 of them will be fine. and there's just going to be somebody who got the trade wrong, got the overnight wrong. We'll learn about it.
There's some big unrealized losses out there. I'm with you. JP Morgan earnings kicking off in 2 Fridays' time. Next Friday, October 13th. Let's check out the price action. Equity futures on the S&P 500 declining just a touch, down 1/3%. The best day on the S&P going back to mid-September, all the way back to August for the NASDAQ. Decent DAV gains off the back of a big move in the bond market. Yields lower. Yields stable this morning, going nowhere. 473.73 on a 10-year. And the euro against the dollar, pretty much unchanged here, Lisa. 105.06.
So is bad news good news again? 8:30 a.m. we get U.S. initial jobless claims. Curious to see whether we actually see a tick up after basically a moribund chart since the pandemic. You've seen it just flatline. This is one key aspect people are looking at. The Fed speak today includes Cleveland Fed President Loretta Mester at 9 a.m., Richmond Fed President Tom Barkin at 11:30 a.m., San Francisco Fed President Mary Daly at noon with myself at the New York Economic Club.
Absolutely grilled.
And Fed Vice Chair for Supervision Michael Barr at 12:15 a.m., which, Tom, I know you're interested in to understand this whole banking response and potential stress. And today, this is an interesting one to watch. European leaders are meeting in Granada, Spain, to discuss Ukraine aid. They're also speaking about migration, enlarging the EU. But this is their first meeting since they announced the probe into Chinese electric vehicles. So how much do they build on this, especially in light of a rather fraught tension right now with the U.S. with respect to aid to Ukraine and just understanding exactly how they're going to move forward economically?
Back and forth with Leslie Vinci-Murray, who's going to join us this morning. And I just wonder if all the intelligent discussions of EV and the rest completely overwhelmed by the migration discussion.
I think we're all just haunted by meetings of EU leaders going back to the
You
Eurozone
lived them. I've never been to one of these meetings.
Just,
it's like watching paint dry, right?
No, thank you. Eric Friedman, CIO at US Bank Asset Management, joins us now. Eric, wonderful to catch up with you, sir. Lisa mentioned Barclays. Only a stocks crash can rescue bonds. Eric, do you agree with that?
We don't, Jonathan. Good morning, everybody. I'd say that our view is that the economy is still in a good place, not a great place. And so we think that there's probably a incrementally, let's call it modestly positive news is probably enough for the bond market to settle down. So take, for example, this morning, you had revisions to July exports from Germany. You also had a worse than expected, current print from exports in Germany. That's giving the European equity market some degree of relative calm. So I think more data points that are incrementally flat to slightly negative is probably enough to get the bond market tamed, as opposed to that let's call it the Minsky moment where, we wake up and something really bad happens. We just think that there's other variables will get rates to settle down, not that really bad cataclysmic type of action.
Eric, we can't leave that there. Are you saying the ideal data point is one that is just slightly negative? Not bad, not good, not great, but just slightly negative?
Let's call it slightly worse than Goldilocks, Jonathan, would be the rule of the day. So, for example, this Friday's job print. If we see something that's like 250 versus the expectations of sub 2, and we see a fanning out of job filling, if you will, that would be viewed as more concerning. So I think that this is an economy that is still in a good place. I don't think that we can really move past that. That the data is certainly incrementally getting worse, but it's still from a very, very strong level. So that gradual wind down of positive news we think is sufficient to get things to settle down, as opposed to that sort of knee-jerk reaction.
Eric, critical question here with the bond hemorrhage we're seeing. I notice a Keefe Bruyette Bank Index by some moving average measure. I got it down like 45% or whatever. Is this a time to diversify? Do you want to diversify here, or do you want to be more focused in sector selection?
Yeah, Tom, our viewpoint has been really to have a 60-30-10 approach to laddering duration. I'll talk about diversification in just a second. So that means that if you own a good pool of bond assets, have 60% of that in the sub 2 range in terms of duration, years of duration, 30% the 2 to 7 curve, and then let's call it 10 out. I think that from a diversification by sector standpoint, you're really not getting paid to own investment grade corporate credit versus treasury. That's not really a high conviction area. We do think there are spots like non-agency mortgages, which is not some esoteric part of the bond market. You can access it through lots of different ways. That's a spot where you're picking up some coupon You're also not taking
Okay, but what about an equity?
So,
what about an equity? Everybody's like, equities have done great. They're not getting hammered like bonds. We're going to spend the whole morning looking at price down in bonds. In equities, are we going to enjoy price down? And do I diversify or focus my sector bets?
Yeah, I think price down modestly over the next couple of let's call it a quarter, Tom. So that gives you a chance to do a couple things. One, we've been saying trim tech. It's been a great winner. Obviously, everybody knows that. The earnings momentum is there. Expectations are a little lofty for Q1, Q2 of next year. We'd still be overweight technology over a longer time period, but we'd be trimming back some of that excess return. The second area that we think is really attractive is energy. This is really, again, it was the darling last year. It's actually at a very, very important technical level right now. If you look at a variety of different things, whether it's XLE or other variables, we are sitting at some really key levels. So understanding what we look into earnings season for energy market is still that discipline from corporations. They've really been forced to by shareholders. So energy is interesting. The other variable that I think is also key is what happens with utilities, that boring, sleepy old area that, of course, is tied to the bond market, is also seeing, again, multi years of support at current levels. So those are really, we think, key variables to pay attention to. But we'd still be involved in tech. We think healthcare long-term makes sense. We'd be, again, paying close attention to energy with a solid fundamental underpinning. Utilities, some key support levels that investors should really pay attention to right now.
What part of the cycle do you think that we're in right now, economically speaking, if you aren't going to lean into bonds, but you are going to lean in potentially to utilities and some other areas at a moment where tech, you think, maybe needs to be trimmed?
Yeah, we think we're in that part of the cycle, Lisa, where there is going to be a gradual slowdown. Again, we are not calling for a recession. We think that call is premature, given the strength that we've seen, not just in the U.S., but also some, call it, modest improvement elsewhere, even in places like Germany that I hit earlier. I mean, these are not necessarily areas that we think are going to be prolonged in a slump. So this is going to be the shallow slowdown point, we think, of the cycle. There's going to be opportunities to get involved, get invested. And so, this is sort of the part where it's not the end of the credit cycle. This is a bit of a midpoint bump, if you will. So that's the spot that we think is a decent place to, again, rotate out of some of the winners and think about some of those sectors that have been a bit more maligned.
Eric, thanks for joining us today. Appreciate the update. Eric Friedman there of US Bank Asset Management. Looking at energy. Let's look at energy right now. Crude, WTI and Brent. Pulling back just a bit this morning. Pulling back a lot yesterday. 83 now on WTI. Had a little look in the last month at 95, all the way back down to the low 80s. We're negative this morning by 1.26%. Yesterday, the biggest one-day drop going back to last year on WTI crude. Bramo, gasoline demand. Looks like that's taken a hit. We talked about stockpiles at Cushing. They're starting to go in the other direction, maybe starting to rebuild. Have we hit a little bit of a demand soft spot here that's starting to play out negatively in commodity markets?
I can't answer that question. It's a really good question, especially given the fact that a lot of people are saying that demand destruction may not kick in until much higher in the price point simply because of inflation. But interestingly enough, gasoline prices have been coming down in the U.S. if you take a look at that. So if you think about these pressures, is this coming off in disinflationary? Good news. But yesterday's move is really something in the crude market.
I don't make a buy, hold, sell bet here, but I'm looking at Exxon with a 7-8% return per year, totally unacceptable. They've got free cash flow, John, popping pre-pandemic 27 gajillion out to 70 gajillion. I think that's a little bit of free cash flow growth. And yet their 5-year dividend growth is low single digit. I don't, what are they, a bank? Is this Game of Thrones? What are we doing?
The stock got to a record high in the last couple of weeks on Exxon.
But, I get the price and all that, but they're not playing conventional securities analysis here. They're in their own la-la land.
Brent this morning, back to about 85, 84, 78 yesterday on WTI crude.
Big move.
Biggest one-day drop since last September, lower by close to 6%, negative 5.7%. Yesterday at the close. Looking ahead, someone who likes energy stocks will catch up with Sarah Hunt of Empire Saxon Woods. We'll do that in the next hour. We'll catch up with Anne-Marie a little bit later this morning as well on her brilliant interview with Congressman Matt Gaetz. The future of the House in Washington, D.C. Everything's a little bit rudderless in the nation's capital at the moment. From New York City this morning, good morning.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
I'm for both of them right now. I'm eager to hear their plans and their vision. But if the House of Representatives goes from the stewardship of Kevin McCarthy to either the stewardship of Jim Jordan or Steve Scalise, that's going to come to the delight of many conservatives.
Congressman Matt Gaetz there of Florida speaking with Bloomberg's Anne-Marie Jourdain and Joe Matthew on Balance of Power yesterday. Fantastic exchange. Catch the full exchange, the conversation on Bloomberg.com and on the Bloomberg terminal. If you're just tuning in, this is your market right now. Trying to bounce off session lows. We are negative by 0.25% on the S&P. The bond market sell-off reversing yesterday off the back of a downside surprise on the ADP report. Let's see if that sticks into the weekend. We've got payrolls tomorrow, jobless claims a little bit later this morning. Yields lower at the front end of the curve on a 2-year by a couple of basis points, still just a little north of 5%. On a 10-year here, Tom, down by a single basis point at about 472.
Yeah, I mentioned again today, John, it's fragile. I still don't have a real yield quote yet. No, well, yeah, sort of I do, 2.39%. I get it that it's calmer out there, but it's got this jitter to it. And off the economic data, we'll see.
This week has been about the data.
Yeah.
To some extent, we can argue to what extent, but to some extent.
We have further
We had decent data Monday, decent data Tuesday, back-to-back double-digit gains on a 10-year yield, and then things turned around on a softer ADP report, which I think speaks to the kind of moment we're in at the moment.
Lisa, in your reading, if we disinvert and get back near zero, the difference in yield between the 10-year and 2 years, is there a tipping point? We're at negative 31 beeps. When do we go, yay, victory?
Is that victory or is that
problematic? I don't know. I'm
if
asking.
We're getting the long end. The interesting aspect of the recent price action, and PGIM's Dalip Singh, formerly of the Treasury Department, put it well. It's a price sensitivity, a new price sensitivity of the buyers in Treasury markets. The insensitive price buyers are kind of backing away, and that, I think, is the big change.
Right now, we're going to digress here. We've got Anne-Marie Jourdain coming up here in the next hour. But right now, we are thrilled to bring you one of the voices. This is something we're really trying to do in this U.S. hysteria, is get deeply experienced voices, not of calm, but maybe of possible reason. That will be Leslie Vinjamuri, head of U.S. America's program at Chatham House, a wonderful migration from Wesleyan to LSE to Parchment at Columbia along the way. Dr. Vinjamuri, thank you so much for coming from London just to see us this morning. What a mess. We've gone over the history lesson of it. Forget about it. Let's move forward. I'll talk to Anne-Marie about this. 4% of Republicans gummed up the works. How did that happen?
Yeah, it's a very strong, powerful minority that has very strong incentives to increase their own popularity and visibility by fundraising by pulling apart at the seams any effort to do what Congress has always done, which is to forge deals that make governance possible.
And John, my question, John, is what percent of the GOP is Mr. Gaetz just talked about many conservatives? That to me is the mystery.
Important question. Framing matters. When you ask that question, I think you might get different answers if you're asking Congress and if you're asking voters.
Yeah.
And I just wonder, with that in mind, Leslie, who's Matt Gaetz more closely aligned with? His own party, the people who vote, or his colleagues in Washington, D.C.?
Yeah, and look, it's no longer a party. This is the thing, right? The idea that the Republicans are a unified party, or frankly that the Democrats are a unified party, is really vastly overstated. It's a fringe of the party. We've seen this happen. And so, looking ahead, it will be very interesting to see. If you look at public opinion, right? The American public, Republicans and Democrats, they want their government to stay open. They actually still support funding for Ukraine. They want some border security. Will we get people in Congress to do what they've always done, which is to override this very radicalized, vocal minority on the far right of the Republican Party and do some deals? And we are seeing some senators try to do that. Schumer and McConnell are talking about this on Ukraine aid. But will they have the ability and the existing rules? That's going to be extremely difficult. We're in uncharted territory.
The Democratic playbook right now seems to be to allow the Republicans to just have their fight, have their squabble, and shoot themselves in the foot and back away and just take the high ground. Do you think that they're going to bear any of the responsibility for the kicking out of Kevin McCarthy by not backing him?
You know, a number of people have come out and said the Democrats, by voting with, have, in a sense, contributed to the problem. Whether the American public reads it that way, I think, is much less likely. And we know when it comes to, where do you really pay the price? You pay the price at the ballot box. And this is, the vote isn't taken collectively. It's taken on the basis for individuals in their individual constituencies. So, will those people really pay the price? Very hard to see that happening.
You mentioned Ukraine. President Biden has made a number of comments indicating that he has other avenues to get funding to Ukraine outside of going through Congress. Do you have any sense of how deep those pockets are, what that funding possibly is?
Yeah, I mean, the first thing is, there is going to be a very significant and very important public relations campaign to drum up support. President Biden has said he's going to make a speech. He's certainly looking into existing funds to see what can be transferred. But, we've also seen, very interesting yesterday, this reporting that President Biden has decided that he will support the border wall, that he's lifted restrictions, state restrictions in Texas to make it possible to allow some of that border wall to go forward. So that is a sign also that this is a president who is going to be thinking about that compromise. And a lot of the compromise that's going to be on the table when we get to renewing funding to keep the government going is going to be about border security and Ukraine funding.
Let's not underplay this. You are the definitive Chatham House voice, transatlantic. You've written on this and you've thought about it. John, remind me, where are the EU leaders meeting? Leslie's not there, but hey.
Granada, Spain.
Granada, Spain. We're in Granada, Spain. There's this. Lisa mentioned EV vehicles. Baloney. There's only one topic. People on fragile boats crossing the Mediterranean. Same thing here. They're crossing the Rio Grande. There's a primal scream, including the governor of Illinois, saying to the Democrats, wake up. Do you see any indication the Democrats will wake up?
Well, I think what President Biden said yesterday, right? This is clearly a president who is looking, he's understanding that a lot of the electoral pressure is going to be, if you look at the issues that Americans care about, migration is very high, and it will play more and more as we move into primary season. And so, yes, I think that there will be increased sensitivity to this from the Democrats.
Mayor Adams is going to the 6th borough of New York City today, isn't he? It's not the Bronx. It's not Staten Island itself.
He's going down to Mexico. He's going down to Latin America.
What's he going to do down there?
Leslie, we spoke to the governor of Connecticut, and he said a moderate is a liberal mugged by reality. Are the liberals being mugged by reality on this topic?
I think that, again, this is a very tricky calculation. There is a timing question. To your question about Europe, same thing, right? That there, we've just had the Conservative Party conference in the UK. We've seen Suella Braverman and others playing to the far right on the question of migration. There is a desire by others to be more moderate, but as the far right becomes more powerful and as the numbers become more visible and more significant, whether it's the Mediterranean, whether it's the southern border, yes, of course, the liberals are going to become more sensitized to this and take it seriously. And again, I would point to the announcement coming out from President Biden, the idea that he's going to actually commit to something that he said he wouldn't, which is to investing or allowing progress on the border wall, is a very significant development.
What does that tell you about how much has changed? Is this really a far-right issue?
This is an issue that the far right has been very effective at putting in the public domain. There are a number of issues, and it's sort of a grab bag of issues, not to underemphasize any of them. But what actually gains traction, it's very much about who manages to mobilize and bring them up front in the media and elsewhere. So it is an issue that has been very significantly understated. But again, there's a question of, is it an issue? And how do you deal with it? What's the policy to deal with it?
Leslie, appreciate the insight, the opinion this morning. Thank you. Thank you very much. Leslie Vinjamuri there of Chatham House. What's that, TK?
She should move to New York.
Maybe she likes London.
Chatham House West.
Yeah. Chatham House West.
Yeah.
Okay. Yeah. Are we done?
I'm done.
Good. Jens Nordvik, Exante data on the FX market coming up very shortly. Some big moves in the FX market. Dollar dominance has been the story over the last couple of months. 11 weeks of dollar strength against a weaker euro. Can we make it week 12? Will we? That conversation coming up next. Equities on the S&P 500 shaping up as follows. We're pulling back just a little bit this morning by 0.25%. Decent day of gains yesterday on the S&P. On the Nasdaq too. Best day of gains since mid-September on the S&P, since late August on the Nasdaq. And you can thank the ADP report for that. A downside surprise on ADP, the appetizer for the payrolls report on Friday, sparking a big move in the bond market. Bonds rallying, yield to lower. This morning, you're lower again by about 2 basis points on a 10-year to 471.44, down about 3 on a 2-year here, just north of 5%. To see the 30-year briefly yesterday, Bramo, breach 5%, all the way back down to 486.28 this morning.
I take Tom's point from earlier that it's unclear exactly what's behind this, but it does feel like the one takeaway is this isn't a rip-roaring rally. And that, to me, is telling, because of all the bond bulls out there, sort of like Ian Lingen yesterday, they're not coming in whole hog. There still is this reticence to really embrace any kind of stability in the market.
You brought up Dalip Singh, and I think it's an important point that Dalip is making. The absence of predictable buyers on the demand side.
Yes.
It's a very, very different story. You can't depend on, you mentioned the central banks, can't depend on that anymore. Can you depend on China anymore? Can you depend on that foreign bidding quite the same way? And I think that's why there's a lot of head-scratching going on. Some people might sit in the chair across from you, Bramo, and say things like there's a buyer's strike. But I think the way Dalip framed it is a little bit more sophisticated.
I would say so. Basically, that there used to be a price-insensitive buyer base, and that included the central banks of places like China, like Japan, as well as a lot of investors. Suddenly, people are waking up to price, and they are becoming much more sensitive to that, even in some of these institutions. That is the sea change, and it is structural.
And this goes to our guest that's coming up hugely, and everybody pay attention to this in Global Wall Street, Jens Nordvig, in a bit. John, I don't want to show the chart because it's got too many lines. People will drop their coffee cup on TV. They'll drive off the road on radio. But the bottom line is, on some of these charts, I'm out past 5 standard deviations. I looked at a Japanese chart today, really sophisticated chart, back 32 years. We've never seen the move ever bottom to top in standard deviation, and I believe it was the 10-year piece in Japan. It's a 5 standard deviation traipse, if you will, to a higher yield in Japan.
Thanks again to the bond team, the bond desk here at Bloomberg, for these numbers. The 30-year bond, Tom, has tumbled 53%.
The U.S. I did not know that.
53%.
Yeah,
that's how bad the price destruction has been.
And we opened with the United Kingdom, where I'm going to guess it's worser. Because you got 1998. You
really, really difficult stuff. Let's turn to foreign exchange and just wrap things up for you. The dollar's shown a bit of weakness just yesterday against G10 this morning. Looking at the euro at 105.16. We're positive on that currency pair by, let's call it 0.1%. Under surveillance this morning, initial jobless claims due at 8:30 Eastern Time. Our survey expecting a print of 210,000 claims, a slight uptick from a week ago. The report coming after ADP data showed US companies adding the fewest number of jobs since the start of 2021 last month, pointing to a slowing in labour demand. The US payrolls report for September due tomorrow morning. We talked to Andrew Honhorst, the City, Lisa, as soon as these numbers came out yesterday. Does it change anything for you, Andrew, on Friday? No. He's still looking for 240.
And he's still looking for the unemployment rate, I believe, to fall to 3.6%. So in the wrong direction for the Fed. The right direction, I guess, for people who are in the labor market. But this really is the tension. ADP doesn't matter until it does, as we've talked about many, many times. Yesterday, it confirmed the hope and the dream of markets that we're going to get an ongoing disinflation. If you do get confirmation of that today in the initial jobless claims, do we see more conviction in this rally? Do we see a greater conviction ahead of tomorrow's print?
I can't go there technically. I mean, I get it. We had a nice, John, what'd you say at the opening of the show? NASDAQ up most since 1990, whatever. You know, we had a nice pop.
Since the end of August, but we can pretend it's 1990 whatever if you want.
That's great. Okay.
You want to make it more extreme, go for it.
It's theater. Let's do it.
Facts don't matter.
The
Go
answer
on,
is it's a one-day pop. We're going to get to this with Jens, his phrase. The bond carnage now is just FT has a wonderful article today on sovereign carnage. Carnage. That's the EP phrase.
Jens joining us in just a moment. A government shutdown next month looking even more likely as the fallout from Kevin McCarthy's removal of House Speaker continues. The House needing to find resolutions on key spending measures, but unable to do so until a Speaker is chosen. Florida Republican Matt Gaetz telling Bloomberg's Anne-Marie Jourdain and Joe Matthew he's back in bids from Congressman Steve Scalise and Jim Jordan to replace McCarthy. Bramo, what's next here?
Honestly, a shutdown, because it doesn't seem like there's really any expectation.
People are
Certainly
predicting
not
that,
Jim
right?
Jordan.
Sure.
People are predicting a shutdown?
Yeah. I mean, honestly, Jim Jordan is probably doesn't have the mainstream votes, maybe Steve Scalise, but to get some sort of coalition at this point, given the animosity right now within the own party, let alone just generally in the House, yeah, basically we're going to be heading for a shutdown.
The story of the last 24 hours, nothing else matters.
No.
Walmart saying it's seeing an impact on shopping demand from people taking Ozempic and other appetite-suppressing medications. The retailer CEO saying this: we definitely do see a slight change compared to the total population. We do see a slight pullback in overall basket, just less units. Tom Keene, slightly less calories. What a change. Just how fundamental the shifts we could see in this economy of one drug.
Okay. Medically on a free lunch, I need somebody really qualified in medicine to tell me this isn't a free lunch or there's a cost on the other side to what is clearly a miracle drug. I mean, I just don't...
It's going to transform potentially the whole of this economy, which has been shaped around an obesity epidemic in this country.
Well, it is an obesity. To be serious,
earlier this week. Talked about airlines earlier this week, which could save on fuel. This is really no joke. Look at Walmart as well. And some of these companies, you talk about adjusting and adapting. Some of these companies, Bramwell, are going to have to adjust and adapt to this.
It is a fraught moment when you have companies that sell food that might not be completely healthy, seeing how they can offset the decline in sales of said calories because people are eating less. It creates a really fraught medical moment for the social discourse and a PR move as well.
John, we've got to inform our people. Lisa, folks, does a half marathon every day when she leaves the office.
I thought you were about to say you started Ozempic.
That's
what I thought was about. I was waiting for this
Lisa is so biased on this. She runs a freaking half marathon 4 days a week when she leaves the office.
Just getting confirmation from the team that we'll catch up with Jen Bartashis on this story in about 10 minutes' time.
Wonderful. Expert on the big box theory. Right now, expert on this linkage of foreign exchange into the bond market. It is the 10th anniversary of his truly important book on the euro, The Fall of the Euro. Jens Nordvig, with tours of duty on Wall Street, runs his own shop, Exante Data. They are definitive. We're thrilled he could join us this morning. Let's link it up here. You call it a bond carnage. How do you link that up to the dollar and foreign exchange?
When we have the bond market moving in a dramatic way, you always want to go and see, okay, what is kind of behind it, right? Is it the inflation expectations that are going up? Is it something to do with better growth, or is it something else? And I think on this occasion, we can definitely rule out inflation expectations, right? We've had very stable inflation expectations over the last couple of months. You can even argue that, the realized inflation has come down, right? So really, it's an issue about, okay, is there something with growth that's better, or is it really supply, right? And if I look at what's going on in the yield curve, we can see it over the last couple of weeks, that all the big moves have been driven by the long end, right? That doesn't smell like growth, right? If it's just growth getting better, we will have like actual tightening being priced into the short end. So it's the long end driving it. The other thing I would say is if you look around the world and look at growth indicators, I'll just pick a very simple one. Like, look at what's going on with copper. Copper is now at a 11-month low, right? That's typically viewed as a very basic growth indicator. It's definitely not flashing something particularly bullish, right? So we have this situation where the U.S. yield curve is shifting dramatically higher in real yields. Not totally clear that it's growth related. It's something to do with the repricing of the curve, right? Maybe it was too inverted in the first place, right? And that real yield increase has been really boosting the dollar in all crosses. But it's not just the yield curve itself. It's also because these higher yields are starting to spread into credit, starting to spread into risk assets, right? So we had having a big kind of risk reduction wave here over the last couple of weeks. It's not like a total panic, but it's broad-based.
Jens, I did my inner Jens Nordvig yesterday. I took DXY as a Plaza Accord proxy, and I figured out the DXY's got to really, really pop to get back to the tensions of the early 1980s. Do you frame dollar at a peak right now, or can dollar extend stronger out to those tension points?
So what we're focusing on day and night is, okay, this, growth outperformance that you have had in the U.S. and also core inflation, service inflation, staying more sticky than other places, what is keeping the Fed in this hawkish mode, right? So as long as the Fed is more hawkish than the ECB, other central banks, it's going to be hard for the dollar to turn, i.e. turn weaker, right? And the other thing is that global growth is pretty soft. That also tends to keep the dollar strong. But the level of the dollar is very elevated. We're getting close to the peak dollar levels we had last year in many crosses, right? The question is, can we really go past them? Keep in mind, last year we had a full-blown energy crisis in Europe. That was what took the euro below parity, right? That's not the same at this point in time. So I think for the euro specifically, breaking to new lows will be hard. It's not the same situation. But at the moment, it's really about whether the Fed stays in hawkish mode. We can also see it, like, just think about the price action yesterday. The yield curve is very much correlated, long end and short end. And when you have weak data points, right, the whole yield curve rallies hard. So the market is looking incredibly hard all the time to find some sort of signals that the U.S. economy is turning and the Fed can change. And just one final comment on that. Financial conditions in the United States have moved dramatically tighter over the last 3-4 weeks. And the Fed has not really talked about yet. So one way we can also get a shift in the yield curve is that the Fed actually says, okay, actually financial conditions have tightened substantially, and that's going to impact our policy. They have not been willing to say that, but given the size of the move in financial conditions from bonds to credit, equities, the dollar, and so forth, all that, I think we're getting closer to a point where the Fed will have to acknowledge that there's something more significant going on in that space.
Hold on a second, Jens. What you just said there is really interesting, especially in light of what Barclays analysts were putting out there, which is we need a huge sell-off in risk assets to get the bond market to rally. Are you saying we're close to that already?
I think if you look at the size of the move we've had over the last month, right, this is one of the bigger ones. And we've not had anything like this since, 13 months ago when we had that big risk off that everybody still remembers. So the Fed is reluctant to say something about it too early, right? Because in a way, they've been surprised that bond yields were so low and so much lower than the 2-year rate. But now the curve is flattened dramatically. Credit is definitely on the move, right? So I don't think we need much more financial conditions tightening before the Fed will definitely have to embed it and definitely say something about it. And that's a new situation we've not had for 6-9 months, really. Really, since the Silicon Valley Bank shock, we've not had any talk about that.
We've had a 150 basis point move on a 10-year since the SVB lows, post-SVB lows. Jens, thank you, sir, as always. Jens Norvig there of Exante Data on the Fed and whether they weigh in on some of this. Later on today, Mester, Kashkari, Barkin, Barr. You're going to hear from Waller tomorrow for whatever that's worth. And Daly a little bit later with Bramo. Mary Daly, I know where you're going with this conversation at the top here, Bramo. Mary Daly on this bond market, are they willing to talk about it, or are they going to take the Goolsby line of things with Joe Weisenthal and Tracy Alloway, which is, I'm puzzled. I'm puzzled by it.
I'm puzzled and watching, but not necessarily materially changing his outlook or his guidance as a result. At what point, to Jens's point, does this change the view of the FOMC when it comes to raising rates again, but also what the threshold is to cut rates going forward?
You want a dynamic? Sri has a Sri index, Sri Natarajan, our ace reporter. Lisa, before this carnage, JP Morgan was 15% greater market cap than Bank of America. It's now 100%.
But is this an issue of stability or is this an issue of profitability? And that's a really important point.
Maybe both.
At attention.
Mr. Barr cares about stability. That's what I'll listen for today.
Earnings 2 Fridays away. Coming up, why Ozempic might be changing spending
You're just
habits.
not letting off. Why are you looking at me every
Walmart.
time you
I'm
do
looking
that?
straight down the camera, not even looking at you. From New York City this morning.
Are you saying something?
Good morning.
The market is looking at this move and saying it's temporary. We're going to have dip buyers come in and we'll reset to lower rates. What I worry about is if this sell-off ends up being sustainable. Envision a world with 10-year yields above 5% for a sustainable period of time.
Ian Lingen of BMO, just one of the best on the street for fixed income strategy. I have to say, almost sounding spooked by what he's seen over the last month. At one point, he called it a screaming buy. I should also caveat by saying I asked him if it was a screaming buy, and he said he thought it was a screaming buy. And Lisa, here we are, something like 50 basis points later on a 10-year, doesn't want to get in the way of it at all, does not want to step in.
I think a perfect time to stay on the sidelines was the phrase that he used, which is a very big divergence from a screaming buy, which maybe you initiated, but either way, he took the bait. This is the question that I have. At what point are we looking at just technical levels and then a rip-roaring rally, or a structural change akin to what Dalip Singh was talking about over at PGIM, where price-sensitive buyers are really the ones out there? The insensitive buyers are not in existence anymore. People are looking at levels and they're looking at getting compensated for the risk.
We've lost that predictable demand. Maybe Walmart has too. Take a listen to this.
Good segue.
Do you like that? Thanks.
That was
on the spot as well. I'll take that. Let's get to this quote from the Walmart CEO saying this. On people taking Ozempic, had this to say: we definitely see a slight change compared to the total population. We see a slight pullback in overall basket. Less units, Tom, slightly less calories. How things are changing at the biggest retailer in this country.
Yeah, when I look at Walmart and, I look at my Ozempic, I look at John Thin 30 probiotics for weight management, the Green Select Phytosome in Thin 30. It's an all-natural, caffeine-free green tea complex that has been clinically shown to have an impact on weight loss and maintenance. Tom Keene, you should try this today. That's Walmart selling me.
Someone emailed you that?
Yeah, well, no, they emailed me. Yeah, Mrs. Keene, $27.97 per bottle, and that's the industry that is there when you walk into Walmart.
The weight loss industry.
Yeah, why don't you bring in Jen here, because you're really on top of this thing.
Jennifer Pantasius,
I'll take my Thin
Senior
30
Packaged Food and Retail
probiotic.
Staples Analyst at Bloomberg, joins us now. Jen, great to have you with us on the programme. Fantastic as always. Just walk us through how much detail the likes of Walmart has on something like this, how they can track shoppers to find out these things in real time.
It's fascinating, and this is really the new era of alternative and big data in action. But the first thing we should say is that Walmart isn't tracking individual people and what they're taking and what they're buying. Instead, they're looking at groups of people on an anonymized basis, and they're saying because they have such large pharmacy operations, they can look at how many prescriptions are dispensed, and then they can look at that group of people who are on a particular medication and analyze their spending habits across the store. And this is really indicative of the health and wellness pivot that a lot of these bigger retailers have been making over the past few years.
How big a slice of the overall shopping base of a place like Walmart are Ozempic takers? I guess, Jen, that's what really matters here. We can track Ozempic, people on Ozempic, and we know that they're pulling back average basket units, calories. What are there in the overall pool of Walmart shoppers at the moment? 5, 10%?
Well, I don't think that they've actually disclosed how big that is. It's still a relatively small percent. But when you look at the overall health profile of the American public, the use of drugs like Ozempic or Mounjaro or some of these other weight management tools is growing. There is a health crisis in this country. And so we would expect that group of people that are on drugs like this is only going to grow, and which is why these retailers are paying close attention now.
I'm just sort of speechless on this. Jen, what are the side effects of Ozempic? I mean, is this one big free lunch that's going to change your world and all of our worlds?
Well, I'm unfortunately I'm not a physician. I can't really speak to the specific side effects. But when the purpose of these drugs is to help regulate your blood sugar, it's to help regulate your hunger levels. And so if they are effective for individuals, then that will play through in your shopping behavior. And so, people who are focused on losing weight historically have tried to change their patterns. They buy more vegetables. They buy fewer processed foods. That's a long-term trend that will probably continue to play out as we see more and more people benefiting from some of the drugs that are out there.
Jennifer, I want to just throw out some statistics. Morgan Stanley has been crunching the numbers. They expect that 24 million people, about 7% of the U.S. population, will be taking some sort of weight loss drug similar to Ozempic by 2035. They estimate that these people could cut their daily calorie consumption by 30% in that time, which is a survey of patients who are currently taking it. How much is this going to be a bit of an issue for some of companies that have kind of designed themselves in the retail business around the snacking culture, around bags of chips, around soda, around all of the types of foods that people are cutting out?
That's a fantastic question, and that is where you see companies like the brand new Kellanova, which is branding itself as a snacking company, taking a closer look at some of these trends. One of the things that when you look at companies like Kellanova or you look at Mondelez, they have initiatives in place that are focused on smaller pack sizes. 100-calorie packs, things that are a little bit more where you can still indulge, but you're much more conscious of your calories. And so we're likely to see an acceleration of that sort of tactic from these packaged food players in response to people trying to manage that caloric intake a little bit better.
The tactic that really was coming after a whole decade, many decades of growing up with a snack culture. I'm just wondering how awkward it is of a moment, and from a PR perspective, for some of these companies to come out. They have to embrace kind of the healthier eating, right? Even though they have grown out of kind of the opposite and just buy more, eat more, do more, and that is part of the problem.
It is, and that's where. So some of the more subtle, indicators over the years, reduced sugar, lower sodium, these are things that these companies are going to fall back on and say, we've been thinking about you for years. Now, whether that's, how much people believe that or not, but that's one of the messages that I would expect that they'll amplify, as this goes on. But let's not forget there's a whole other segment out there, which is fast food, which could also be impacted by the taking of these kinds of drugs.
Some of these numbers are amazing, Tom. 26%, this is the Morning Consult poll. 26% of US adults said they're interested in taking drugs like Wegovy and Ozempic for weight loss.
Okay, so Jen, folks, we're underselling her. Jen is encyclopedic on this, and particularly big box retail. Excuse me, Pepsi is, I'm gasping because I missed my Ozempic this morning. Jen, Pepsi is selling into Walmart. They're having a meeting at Frito-Lay this morning going, what do we do? Jen, what do they do?
Well, I think that for retailers like Walmart, and these big package companies like PepsiCo and others, it's about having a conversation, and it's about how you find, mutual benefit out of the products that you have, where you're going to choose to do promotions and marketing, and how you're going to let the consumer know that there are parts of your brand portfolio that can meet their needs, regardless of what your individual focus is. So there are going to be people who don't care what they eat. They'll eat as many calories as they want. But for people who are on some of these drugs or who, are looking to lose weight, this is where this, idea of personalization and floating things up to customers based on their other patterns comes into play. And so it's really going to be a collaboration between the brands and the retailers to position products in the right way for the right customers at the right time. And that's the pattern that we've been seeing when they're talking about their approach to how they're going to be doing marketing and personalization and all that type of work going forward.
Hey, Jen, wonderful to get your insight. Jennifer Bartash there of Bloomberg Intelligence. A lot of this stuff is like the next decade, the next 5 years, the next 15 years. Future's now. Barclays, in the last week, recommending shorting fast food credit. Ramo, because of Ozempic.
If you talk about a 30% decline in caloric intake, and you talk about a wide swath of people who probably may disproportionately frequent some of these outfits, you are talking about a real loss of potential revenues. I just am wondering, how you extrapolate out who's going to take it, how they're going to take it, what else is developed, and then what does this do to a model that was really built out of a snacking culture, eating quickly?
Well, I don't know about the Abramowicz house. The Abramo house, she won't let me go over, folks. It's just totally green, it's gluten-free and all that. At my house, they're chowing down Doritos salsa verde. I ate one of them the other day, and it basically was eating a spoonful of salt.
I
That's
walk
what
into
it felt
your
like.
house and I bump into a bar cart as soon as I go in.
The bar cart?
Yeah.
Yeah, but the bar cart's got wheels, so we can move it out of the way.
You can really just keep moving it
That's
along.
No, but seriously, do you have Doritos Salta Verde at your house? Bags of that stuff?
Not a huge fan. I don't like
Doritos? Absolutely not. Coming up, Sarah Hunt of Alpine Saxon Woods is going to be joining us. Doritos. Abramowicz, at mine. No chance. No chance.
We see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
One of the reasons treasuries are so high compared to other parts of the bond market is simply there's such an enormous supply of treasuries.
For all intents and purposes, there's a buyer's strike in the Treasury market.
Obviously, we're focused on that 10-year, right? The 10-year needs to stabilize. Everyone's watching that.
The fact that 10-year yields are higher, I think, is probably consistent with what the Fed is trying to achieve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a month it's been for the bond market. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market trying to stage a recovery this morning. Off session lows negative by 0.1%. Really decent dev gains on the S&P 500 yesterday. Pushing ahead now to payrolls Friday just around the corner. Jobless claims TK a little bit later this morning.
The eco data is important. Lisa's going to have that. I think it's really, really germane to the debate forward for the Fed and for Fed speakers. Mary Daly with Bramo today. Must listen, must watch at the Economic Club of New York. John, 4:53 a.m. this morning, the 2-10 spread popped 30 beeps to a 29 handle. We have massive disinversion still going on. This isn't over. I look at the screen. I'll take your point. It's calmer. That's all.
It's all led by the long end, the 10-year and the 30-year over the last month. I know this morning might be a little bit different. Looking ahead to that Facebook, Lisa, Mester, Kashkari, Barkin, Barr, and you've got Daly. Do they start to talk about what's happening here in this bond market?
They kind of have to. They've been tiptoeing around it a little bit, but there was an interesting story in the Wall Street Journal, talking about how on the margins, the bond sell-off does threaten some of this discussion for a soft landing because you're seeing conditions tighten very dramatically on the long end. Do they lean into this? This is incredibly unusual at the end of an economic cycle. Usually you see bonds rally on the long end as people expect there to be some sort of downturn and for Fed rate cuts to come on the wake.
I don't want to steal your brief here in moments. I know you're going to mention it, but Michael Barr to me is the key voice today. This is about the banks. Lisa, it's about October 13th when J.P. Morgan trots out. Let's assume J.P. Morgan made all the right decisions. Lisa, their market strategy is unfreaking real. So they're going to do market strategy. They're going to get the bond market right. I get it. But guess what, Lisa? There's other banks out there that are really going to have troubles.
This is what people are looking for, is some sort of circuit breaker that can come in and to cause a real renewed rally in bonds. And John, that's really the question. If there isn't that circuit breaker, then do we end up in a higher yield environment that is very different to anything that we've gotten used to over the past couple of decades?
Outside of bonds, what is the market telling you about the economy right now? Spreads are wider, bank stocks are lower, discretionary sucks. That's not the year, that's just the last month so far. Isn't that telling you that outside of bonds, the market's starting to think about that weakness now in a way that it hadn't a couple of months back?
Absolutely. And the overall index has been buoyed by tech stocks and by this sort of preeminence of artificial intelligence. You're right. But that's kind of by design. It's actually a feature, not a bug. So if we end up seeing it accelerate in an unruly way, that's when the Fed will care. Other than that, isn't this exactly what they've been trying to get the market to agree to?
Key point. We've gone restrictive. The Bloomberg Financial Conditions Index has gone to a negative statistic, which is finally overtly restrictive. And you get back to Dominic Constam's phrase, super restrictive.
Couldn't agree more. It is the objective right now. Let's get to the price action. Equity futures slightly negative, softer, down by 0.1%. Yields come in a couple of basis points. We're down 2 to 471.44 on a 10-year crude. Oil having a really rough 24 hours, down almost 6% yesterday, down 2% this morning. Lisa, 82.54 on WTI.
That's one of the biggest mysteries, I think, out there when you say looking outside of bonds. What we are looking at, as well as the economic data, will it confirm the weakness that John was just talking about? 8:30 a.m. we get U.S. initial jobless claims expected to tick up, but every time we've been expecting them to tick up from very low levels, they have continued to go down. So we shall see. Today we do have a slew of Fed speak. You've been talking about it. Cleveland Fed President Loretta Mester, Richmond Fed President Tom Barkin, we have Neil Kashkari, we have San Francisco Fed President Mary Daly at noon at the Economic Club of New York, and Fed Vice Chair for Supervision Michael Barr at 12:15 a.m. Yes, I'm curious about what Michael Barr has to say, but more so, is there a theme that starts to develop between all the Fed speakers and how they are looking at some of the moves that we have seen in longer-term bonds? And today in the EU, this is really also a very interesting moment for AG Ukraine, for the whole European-China tension that spat. EU leaders are meeting in Granada, Spain. They're talking about Ukraine aid. Curious to hear what they have to say about the U.S. Also migration. Also, this is the first meeting since the bloc announced its probe into Chinese electric vehicles.
Emery Horton with us this hour. She sent me a note that Biden is also looking at Ukraine with great focus today.
Going to get a speech, aren't we, on Ukraine aid?
I think so. I don't know.
I think that's what a lot of people are expecting. Sarah Hunt joins us now, Chief Market Strategist at Alpine Saxon Woods. Sarah, good morning.
Good morning.
I always go to energy with you at the end of the interview. We should go there at the start. Crude was dreadful yesterday, down almost 6%. I know that things at Cushing looking a little bit better on the stockpile side of things. Gasoline demand really soft as well, based on a recent read. What do you make of the recent moves?
Well, I mean, we talked about this last time. If crude prices rise really quickly, then gasoline prices come up commensurately, and then all of a sudden you do have a backing down in demand. And I think part of it was the demand numbers on gasoline. I think part of it is also sort of the parallel to the bond market, which is all of a sudden the market's going, well, if we do have a recession or if the world is slowing down, then crude prices may be too high. And part of the reason they're high is because the Saudis have taken some off the market. It's not just a problem of higher demand and not enough supply. But I think the supply side is going to stay somewhat restricted, and I think that's really going to ultimately be the longer term story. But you are going to have these convulsive moves, and the stocks hadn't caught up, not all of them anyway, to the higher prices in crude anyway. So I think that there is still some room in there, but it is going to be a volatile trade.
I'm calling this Never Ever Thursday because I'm looking at bond charts that I've never ever thought about or imagined or visualized. Mathematically, folks, this is truly, without a cliche, this is truly original territory. How do equity participants react to never ever things in the bond market?
Well, I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets. And I think that part of the issue with equities has always been, if rates do stay higher, what are we discounting those cash flows at? I don't disagree that technology is one of the places that will actually do well, even in a higher rate environment, because you've got that stability of earnings, and they've also got a lot of cash on their balance sheets. But I think that the question of what everybody else is going to do and how that's going to impact people's balance sheets. Corporations in Europe, I read a story this morning on Bloomberg that said that corporations in Europe are finally back breaking down and issuing bonds at higher rates than they would have a year ago. So are people starting to accept that? And if so, that's going to take some of the money out of the income statement because they're going to be paying higher prices. So I think that some of that is going to impact the earnings for next year, and that's still what I don't think is really reflected through next year.
The heart and soul of this is Q4 into next year. Do you go with a diversified virtual index fund, tight R squared approach, or are you active and take a less diversification approach? Which is it? I got my own opinion, but which do you think?
I think active. I mean, that's also
active, more narrow.
More narrow, and also looking at where you think there might be some vulnerability, which indexes can't really do, right? Because they are going to rebalance the way they rebalance. And I think that there are some places that are going to continue to be vulnerable.
Do you think that the bond sell-off has been coherent with the other moves that we've seen in the markets?
You know, it's so hard on these very short-term moves to figure out, is this a technical problem? Is this a quant problem? Where is this coming from, or where are these moves coming from? And I think it's very difficult to parse that out and say how it interacts. But I do think that there are large positioning changes. And when those happen, it's not always easy to see. I mean, was questions about whether or not the BOJ was intervening, right? Because the yen went through, and did that happen? Or was that just a technical level that everybody said, oh, 150, we're getting so close, we have to do something. So I'm not really sure on those very short-term moves how they go together. But longer term, they will start start to make more sense. Although, you've had correlations that are very different over the last couple of years than normal. So make more sense is a relative term.
The reason why I ask that is because if yields stay at levels that we're seeing right now, if there is something fundamental behind this or even structural when it comes to price-sensitive buyers, newly price-sensitive buyers, how much does that change the equation for you in the equity sphere? I mean, aside from oil, aside from some of these specific bets, is there a rethink about the value proposition with some of the overweights you've had to equities?
Well, I think that you've been seeing that for the last 2 years, right? Or the last year and a half. Since the Fed started raising rates, the question has been, with or bonds, right? Where am I going with that? Because I'm now putting them back in a portfolio. When you talk about the big price erosion from the lows, when the 10-year was sitting at basically 20 basis points, the fact that we're now up at levels that are over 4, I think people have been looking at that the whole time. But the problem is that as they've been adding the whole time, the prices have been coming down. So there's a little bit of scorched earth on the bond side, too, because people have lost money in bonds and in ways that they hadn't in the last several decades. So I think that there is absolutely room for fixed income in people's portfolios. They are putting it back. But that was traditionally where you had some participation anyway. And I think that higher rates make that something that people look at more seriously, especially as duration starts to look a little higher price than it was, because you were sitting high rates on the low end, but on the short end, but not on the long end, and that's starting to change a little bit. Not necessarily for the best for everyone. But
just pulled up a quick chart. Average Fed funds going back to the 70s. Average is 493. I know that's skewed by a decade of zero, but the average is 493. Is anything on a long bond close to 5% just a screaming buy based on history, or can you tell me that things are going to be markedly different over the next couple of decades?
Well, I think if governments hadn't indebted themselves to the extent that they have, then you could look at some of those numbers and say we should have higher rates on the long end, because that was also more historic. But if I think about what that's going to cost governments, I have to wonder whether or not we can collectively keep rates that high. And I'm not sure that we can control the long end as much, but I do think that going back to what we used to think of as more normalized is a little bit difficult given the fact that we've got this massive amount of government balance sheet that we didn't have 20 years ago.
This is a big question. It's difficult to answer, but what is normal? The last 10 years, the 10 years before that? When we say things like normal, what is normal?
That's going to be, I think, one of the biggest issues playing out going forward. Is the more normal what happened after the great financial crisis, and now that we've gotten this level of balance sheets for governments, do we just stay here and every time we have a problem we just keep adding to them? And does that break something eventually, or do we go back to something that was before that? And I don't know what the answer is, and I think that tension is part of what's going to be playing out going forward in both the bond and the equity markets, because it definitely had an effect on the equity markets as well. You can't say that it didn't with multiples where they are right now.
You can feel that tension at the moment because you get these yields that people have been wanting for a long, long time, Lisa, and there is just that refusal to jump in, both hands, and buy it.
Because people don't understand it. And that's the bottom line. They don't understand how much heft is behind it and whether it's the new normal. And the new normal could be even higher. And we heard that from Margie Patel. Why buy bonds right now if, we're seeing maybe 4.7% on the 10-year, but it could go to 5, it could go to 6. I mean, why stop now?
471 on a 10-year at the moment, down a couple of basis points. At the front end of the curve on a 2-year, we're down about 3 basis points, still just north of 5%. Let's see if we can hold that level going into claims a little bit later this morning, onto payrolls tomorrow. If you are just joining us, welcome to the programme and tuning in. Your S&P 500 is negative here by 0.2%. Yields are a little bit lower by a couple of basis points, 471.44 on a US 10-year. The dollar showing some weakness here. The euro just a little bit of strength, 105.14. Keep going back to the commodity market. Biggest one-day move lower on WTI crude going back to last September last year in yesterday's session. We're down another 1.8% this morning to $82.70. TK, after we heard all these triple-digit crude moves, these calls over the last couple of weeks, here we are back down to 82.
Maybe it's a discussion of global GDP and, this idea of where demand's going to spin off. I don't know. I'm going to leave that to Will Kennedy and Javier Blas and the team. But I just can't emphasize enough within all this conversation how original a place we are in shifting. John, you had the Bloomberg article, which is hugely responsible today, on price analysis of bonds. There's no other story this morning.
Just to pick up on the crude story, because I do find it interesting what happened yesterday, this idea that we got this massive decline in price. how quickly narratives shift and how exhausting it is, because one day everyone's talking about how it's runaway growth, reinflation, we're heading toward that. Oh my goodness, China's doing better than bad. All of a sudden oil prices to the moon, and now all of a sudden they're sinking like a rock, most in more than a year, and people are suddenly saying, well, things are cooling down, rates are having restrictive policy. I mean, this is narrative roulette at a moment where people are trying to grapple with some of the potential
In 6
influences.
trading days, have gone well over 4 standard deviations in Brent crude.
James Astley of
6
Aberdeen called
days.
it narrative table tennis, didn't he, at the start of the year? And
I love that.
It feels that way. Sarah, thank you. It's good to see you as always. Sarah Hunt there of Alpine Saxon Woods. Coming up on the programme, AMH down in Washington, D.C., weighing in on the recent drama in the nation's capital. Peter Schitt of Academy Securities coming up in the next hour at about 8 a.m. Eastern Time. All of that still to come from New York City. Stocks trying to stage a recovery. Decent dev gains yesterday. We're down just a touch this morning by 0.2%. Good morning.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
My mission is to ensure that the House of Representatives runs better. If Kevin McCarthy had passed a budget and followed the law to move 12 single-subject spending bills, regardless of whatever's going on, he would still be the speaker today. It was his unwillingness to do that and his desire to centralize power in contradiction to the agreement he made in January to become speaker that led us to this moment.
Congressman Matt Gaetz there of Florida speaking with Bloomberg's Anne-Marie Hordern and Joe Matthew on balance of power. AMH coming up in just a moment. This is what's coming up later. Jobless claims a little bit later this morning. 1 hour, 13 minutes away. On to tomorrow. Payrolls Friday. Your price action looks like this. Equities on the S&P trying to stage a recovery and turn positive. We're negative here by 0.2% after a really nice day of gains on the S&P. Supported, triggered, sparked by this bond market rally, which continues. Yields lower by a single basis point. The 10-year 4.7227. Tons of Fed speak through this morning. Mester, Kashkari, Barkin, Barr, TK very interested in the Vice Chair of Supervision over at the Federal Reserve, looking ahead to bank earnings in 2 Fridays. Tom, not Barr. Mary Daly, a little bit later at the Economic Club in New York, midday with Bloomberg's Lisa Abramowicz. Look out for that a little bit later. We'll take that. Tom on Bloomberg TV and Bloomberg Radio.
It's going to be an important conversation. Again, let's review that. Let's do that right now. Bramo, to review these troubled banks X number of months ago was on the daily watch, right?
Well, the San
As a
Francisco
general
Fed
statement.
was the oversight to the SVB situation. Look, we're at a moment right now where it goes beyond the banks, right? It goes to this question of at what point is a rate at these levels unsustainable for an economy that was built up on under a low-rate regime? And that, I think, is what everyone's grappling with, including Fed officials.
It's going to be interesting to see. We're going to do this now and jump to her. It's so important. Anne-Marie Hordern and Joe Matthew with their important conversation last night with the congressman from Florida, Mr. Gaetz. Anne-Marie Hordern is our Bloomberg crisis correspondent. Anne-Marie, you're at the Capitol Grill last night having a celebratory beverage. I know you're having the in fashion, the Russell Reserve 10-year small batch bourbon, Grand Marnier, black walnut bitters, and other things I can't mention. Can Matt Gaetz get a drink at the Capitol Grill? What is the reaction of Washington to what he has wrought?
Actually, if you honestly want to know where Matt Gaetz usually I think, hangs out, because I've seen him there before, is the old Trump Hotel, which is actually a beautiful building. It's now no longer owned by the Trump family business. Old U.S. Post Office, Tom, you're ever in town, you should check it out. But this individual is not liked amongst his conference at the moment, and you're hearing a lot of voices say that actually they would like to expel Congressman Matt Gaetz. He is the one that was the driving force behind this motion to vacate, and there's a lot of fire right now and fury within this Republican caucus. Right. And what you hear a lot of people talk about is that this is not going to be wrapped up, meaning who can they coalesce around to be a speaker by next Wednesday. They think this is going to be a long, drawn-out process because the battle lines really within this conference are drawn, and they have such a slim majority. So you could see it's very difficult for the hard right flank and the centrists to really get together behind one name.
News goes on. The president has an active day. Let me do one more question on this. I just think it's interesting. 4% of Republicans get in the way. I think my math is 96% of Republicans don't believe in all of this. Those 96% of Republicans, do they have a favorite for Speaker?
Well, right now it does look like it's either going to be the top two contenders would be number 2, House Majority Leader Steve Scalise. This is an individual that is really a fighter. He survived a shooting, an assassination. He's right now undergoing treatment, though, for cancer, but he says he's ready. And then there's Jim Jordan. This is someone who is a big fan of Donald Trump, and Donald Trump is also a big fan of him. He's House Judiciary Chairman. He was a big backer of Speaker Kevin McCarthy. He said to us before that vote, I'm going to support Kevin. I do not want this job. But now with Kevin McCarthy out of the job and out of this speakership chair, it does look, Jim Jordan announced that he will go for it. The issue is someone like Jim Jordan, what does that look like for, say, a Congressman Mike Lawler in the Hudson Valley District that Biden won by 10 points? Is that person too far to the right for him to vote on? And this is why, especially we're a year out almost to next year's election, this is why it's so difficult for those centrists and those moderates. We should also note, Tom, I'm glad you brought up those percentage points. Congressman Matt Gaetz yesterday wanted to bring up the Hastert rule, which isn't a real rule, but something a lot of Republicans like to live by, the majority of the majority. And he says that's his issue of why he has a big concern with Ukraine aid, because the majority don't report on the Republican side. Yet, he doesn't care about the majority when it came to ousting Kevin McCarthy.
And does Congressman Gaetz still have the support of his constituents?
Listen, he is in a deep red district. And what he has been doing off of this is fundraising. And I'm not sure how much money he's been making on that. I'm not sure he knows just yet as well. But he was fundraising off of ousting the speaker. And he says that he is bringing common sense back to Washington. No longer of these omnibus bills, no longer of these stopgap funding measures, but he continuously talks about these 12 appropriation bills, which we should know the House had been doing work on, maybe not fast enough. But he's in such a deep red district that he has some support, but it's on shaky ground. The New York Times did a big deep dive into how he is a little bit controversial as well back home.
Anne-Marie, there's a question about just how much consensus there is aside from what people call the fringes. And yet yesterday, Patrick McHenry, the interim speaker, evidently reportedly kicked House Speaker Nancy Pelosi and former Majority Leader Steny Hoyer out of their office to put Kevin McCarthy as sort of an emeritus House Speaker role to that space. Does this speak to a real animosity that's going to make it very difficult for anything to get done and for Congress to get back up and running?
Well, first off, Congress, first order of business is they need to elect a new speaker. There's a lot of debate about how much power an interim speaker like Patrick McHenry has. Can he bring actual bills and legislation to the floor? We're looking at potentially a government shutdown come mid-November. When you're looking at Steny Hoyer and Nancy Pelosi being kicked out, you know, is that just retribution? This is not their full-on congressional office. This is a hideaway office within the Capitol. But I think it was quite telling that Speaker McCarthy, when he had that Q&A with reporters, he said that he gave this motion to vacate rule, that one individual can oust the speaker. He said he gave that to the far right as part of those conversations because he said, Nancy Pelosi said to him, give it to him, I'll always have your back, I want to protect the institution.
MH, just want to finish on this. Consequences of all of this. Do you sense the president is softening on certain issues regarding border security and doing so in exchange to get Ukraine aid?
Well, we do know that the president wants to start building 20 miles of a wall, a part of that's a border of Texas and Mexico. We also should note today we do have Secretary Blinken, Mayorkas, Merrick Garland in Mexico talking about fentanyl, migration for the Mexican side. They want to talk about guns that are coming into Mexico. So you do see the president having to focus on this. But, Jonathan, I don't know if it's because what's going on in Congress or it's because what he's hearing from Democratic-controlled cities. Mayor Adams is also making a trip to the border this week. And then you had that letter from Governor Pritzker of Illinois sending to the president saying more needs to be done about what is going on at the southern border.
He's
getting a lot of pressure from his own party.
Massive campaign issue potentially, AMH, for next year, isn't it?
Yep.
Yeah, 100%.
AMH on the latest down in Washington, D.C. Anne-Marie, thank you. A real softening from the president, Tom, on that issue. To AMH's point, and I think it's the right point, it's not just about Ukraine aid. This is about pressure within his own party, from his own Democratic colleagues in blue states and blue cities.
And it's serious enough now. I mean, the governor of Texas has got to say, well, I guess I jump-started that debate. But the answer is, you mentioned earlier, Mayor Adams of New York is in parts of Central and South America talking it up. Lisa, I thought you had a great, point there. I mean, this is front and center. Pritzker of Illinois is fired up.
My problem with it is just, I don't know that there's actually any kind of ability to come to a consensus about actual rational immigration policy that would need to be changed in order to really create a situation, right? I mean, it's going back to some of the classic hot button issues that are sort of just,
I think America's not on the same page as the politicians. I think America's got a whole other view, and all of them don't want to talk about it.
Kelsey Barrow, JP Morgan Asset Management, joining us very shortly on this bond market. What a month it's been. Your 10-year now, 472. Yield to lower, a single basis point. From New York, this is Bloomberg. Great guest coming up on the bond market, so let's whip through the price action and some stories for you. Equity futures on the S&P 500 looking like this, pulling back by 0.15% on the S&P, following the biggest one-day pop, one-day rally on the S&P, going back to mid-September. On the Nasdaq, going back to the end of August. In the bond market, we look like this morning. A rally yesterday, triggered, inspired by a big downside surprise on ADP. We'll see if that changes with jobless claims later and payrolls on Friday. Yields down again, just a single basis point. The 10-year, 472.27. A 30-year had a look at 5%, pulled back. We're all the way back down to 486.93. We're up a single basis point, which incidentally I think is where the 10-year was yesterday, which is where the 30-year is now. So bear that in mind, just how quickly things have moved in the space of a trading session. In foreign exchange, we're shaping up as follows. The euro shown a ton of weakness against this strong almighty dollar over the last couple of months. 105.19 against the US dollar. That currency pair is positive by 0.1%. Under surveillance this morning, Chicago Fed President Austin Goolsbee saying the timing of the bond sell-off has been something of a, quote, puzzle, given there was no major change in the Fed's latest projection. Speaking to the Odd Lots podcast, he said he's confident the US is on the path to the mother of all soft landings. Today we'll hear from the Fed's Mester, Kashkari, Barkin, Ambar, and Bramo's going to be sitting down with Mary Daly of the San Francisco Fed. Lisa, this from Andrew Hollenhorst of Citi just moments ago. Fed officials won't push back on higher Treasury yields. We'll see if Mary Daly does a little bit later.
They're not going to push back if it really confirms the higher for longer thesis. We even heard Raphael Bostic, often thought of as a dove, coming out and saying higher for longer, higher for longer. They want this. This is going to actually affect their policy. I do have to say, the mother of all soft landings, we can't let that go. You can't. I mean, this is sort of the irony of the moment, right? How do you reach this perfect equilibrium and create a drama and a romance around it that you normally get with a crash, a sell-off, a massive rally, etc.? It's like, the mother of all soft landings.
Some of that's the language of Goolsbee. I mean, he's known for that. But the word puzzle there is a code word for, John, we don't have a theory on this.
True.
Puzzle, I see in academic literature, Greenspan would say, I'm puzzled. And what he means is there isn't a book that can explain this to him. And where we are in bond price losses now, there is no book. As I said earlier, folks, we are at, on this Thursday, never, ever. So's Austin Goolsbee.
There's so much confusion, Tom, because there is so little confidence about what has driven this move over the last month at the long end, on a 10-year, on a 30-year. Crude has been all over the place, posting its biggest one-day loss in a year. The WTI falling close to 6% yesterday, the most since September of last year. Ed Morse of Citi writing that the rally in crude has reversed as, quote, bond markets have been signaling economic weakness and US gasoline demand continues to lag. Collapsing prices likely informed the OPEC Plus decision to stay the course on output cuts to year end. That's an interesting interpretation, Bramo, of what's happening in fixed income.
Yes, I would agree with that. I also think it speaks to the fact that we don't understand what's driving a lot of markets. And what did you call it? Narrative table tennis? Who is the one who coined that?
That was James Athey of Aberdeen.
I really lean into that because right now it just highlights how you can create a different narrative around the oil market, around the bond market, depending on who you talk to and how you frame it. And it feels like, depending on the day and depending on the price action, we get a different one.
Have bonds been signaling economic weakness? I think there might be the recipe for it. I'm not sure they've been signaling it. Typically what you'd expect for a bond market signaling weakness would be maybe a bull steepener, rally at the front end because we're about to get a ton of rate cuts, maybe a rally at the long end because you're pricing in lower growth and rate cuts in our future, 10-year rallies, 30-year rallies. That's not what we've seen over the last month.
100%, you're absolutely correct. And if anything, it's really signaling strength. However, some people could argue that finally the bond vigilantes are pushing back against a fiscal instability that they're feeling in the U.S. economy that could speak to a weakness going forward that I can tell that Tom really leans into.
I really disagree with this. John, there was a log convexity, there was a log convexity here where there was a stabilized drift function. No question about it. Guess what? Like a rock out of the Leaning Tower of Pisa in Italy, the rock dropped and we're in a free fall.
You're offending nobody today.
And the free fall that we're in now is simply, just like in equity, the bid went away.
Yeah.
I wouldn't overthink it. The bid went away.
Ian Lingan-Bemo, buyer's strike.
Yeah.
That kind of sums it up,
Bid
doesn't it?
just walked away.
Last story. President Biden has sent his dog away. Commander. It's going from the White House. This is the second German Shepherd that Biden has had to relocate following at least a dozen biting incidents involving White House personnel. We'll get so much stick for this story. Commander's gone, TK. I know you've been following that closely.
I got home. Vet Bill was really upset. Kennel Fee's like, what took so long?
Yeah.
And, I frankly had dogs like this. It's not funny. And the answer is, what in God's name took so long? I mean, that's my only question. If a dog bites, a dog bites.
Do we know where Commander's gone?
Yeah, they take him up. They take him up a northern road in the Adirondacks.
Stop it. Get to the next
north
guest.
of Utica and Rome. North of Utica.
I mean, literally, that is on you.
North of Utica and Rome.
That's how the carry-on's gone to the farm.
Come on, let me finish. Guys, north of Utica and Rome, just before Old Forge. Just before Old Forge, John, Uncle Bud.
I feel bad.
We got a great guest. Commander's at a safe home if there's any children listening.
Kelsey Barrow is probably going to walk off the stage. You got something to read here, John? I'm sorry, I lost the script here. I was laughing so hard.
No, I don't.
We're going to go into this, and right now for Global Wall Street, we're going to freeze time. We're going to get through this for Bob Michael and Kelsey Barrow because they're the real deal. They're at J.P. Morgan Asset Management, and we're going to ask a really delicate inside baseball question so she can go back to the new skyscraper on Park Avenue. Explain without addressing your bank, your business. Mr. Diamond would say that's appropriate. The decisions being made right now of my bond losses, I have to mark to market versus I can hide them somewhere else. Go.
Right. So we've been talking about the losses in the bond market. I think it is important to put into context, though, the majority of the pain was last year, right? The U.S. Ag was down 13% last year, down 2% this year. But more recently, we have seen this backup in yields and this pain that's coming. Now, I think the reason why the stress in the banks has been a little bit less acute this time around than in March is because of the BTFP program, so the Bank Term Funding Program.
Right.
Close, not exactly though. So BTFP, the Fed put that in place in March. And I think if there's one thing that really was crucial to turning the markets around at a point where we were very stressed, we were very uncertain about how things would go in the future, that BTFP program was important because banks can now pledge those treasury securities, and even though they have a price in the marketplace of $70 or $80, they can be pledged at par. So there's been this stabilization factor that was not there back during the March crisis.
So are we saying as these unrealized losses get greater, they matter less?
They are mattering less right now. I think there is still stress, though. This is not the end of the story, right? Even though this facility is in place, people are using it, there's $108 billion in the facility, there still is going to be pressure on margins. It's not only about the mark-to-market losses, but it's about the fact that net interest margins are under pressure. So, as an investor in financials, you do need to be very cautious about where you're investing, understanding the portfolios and the balance sheets of the banks that you are investing in, and being aware of the game changer that was the way the Fed reacted back in March.
Are the banks' ability to finance the economy curtailed by the dynamics we're talking about? Are they constrained?
Yeah, so if you look at the H8 data, and I love to look at this every single week on Fridays, I'm looking at Lisa because I know she looks at it too.
All the time.
What you're going to see is that credit has been contracting in the economy. If you look at C&I lending over the last 3 and 6 months, it's negative. If you look at the senior loan officer survey, it's showing that there is tightness in credit conditions. And like you mentioned, Lisa, this is exactly what the Fed wanted, right? They want to engineer tighter financial conditions. So I disagree with the quote from Goolsbee that he doesn't know where this is coming from. I really do think that this stems from the September FOMC meeting and the dot plot. Sure, they still showed cuts next year, but what they showed is a real policy rate that actually goes up by 50 basis points next year. That is a very hawkish message, and the market is still trying to digest that right now.
So if we're talking game theory, this is basically the idea from your perspective, it sounds like, that the Fed is trying to signal hawkishness so they can engineer the landing so that then they can reverse course and cut rates. How do you respond then to people, including what we heard from Dalip Singh over at PGIM, that there is a structural change in the bond market where some of the long-standing price-insensitive buyers are no longer there?
So there has been a big repricing, and I think this is why you need to look at this not just from an emotional perspective, not just from the ping pong narrative, but also from a logical perspective. What do valuations look like right now, and what are the guardrails to those valuations? Look at the five-year real yield right now. It's around 2.3%. That is the same, or the average rate that the five-year real yield was from 2003 to 2007. So we've already repriced not just to the pre-COVID levels, but to the pre-GFC levels. So regime shift has really already happened. In our view, it's actually an overshoot. But it's already happened.
Although I will just push back, and I know that you've been bullish on treasuries and talking about going back down to 3%. Have you reconsidered that call at all, especially in light of some of these structural changes? Yes, we can talk about inflation, but Torsten Slok of Apollo just putting out Treasury auction sizes will increase on average 23% in 2024. We have evidence that a lot of the central banks around the world, traditional buyers, are no longer buying. Doesn't this change your outlook more materially?
So the technicals do matter, particularly in the shorter term horizons, but we do think ultimately the fundamentals and the valuations are going to weigh over those technicals over the medium term. Inflation right now, the 3-month run rate on core PCE is 2.16%. I mean, we're at the Fed's target. We're not in the 1970s and the 1980s here in terms of the economic growth environment or the inflation environment. I think that there has been a buyer strike.
Cut to the chase. They're fighting the last war. Is that what you're saying? You're having coffee with Mike Ferroli over at J.P. Morgan. Can you guys agree Goolsbee and the rest of them are fighting the last war?
Yeah, they're fighting inflation that I think is already clearly coming down. And I understand why they're going to wait until it's painfully obvious. But in my mind, that only just reinforces the risk that hard landing should be much more of a higher probability than soft landing, because the Fed is telling you, we're not going to stop until it's painfully obvious that the economy can't handle it. And the housing market, you look at the mortgage application data from yesterday, it clearly can't handle it. We think that the economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
10-year right now, 472. Cassie Barrow there of JP Morgan Asset Management.
Just brilliant.
If you are just tuning in, welcome to the program. Your S&P 500 shaping up as follows. On S&P 500 futures going into the opening bow, we look a little something like this. We're negative just 0.01%. So Cassie, listening to you, it sounds like screaming buy, 10-year, 30-year. Both hands jump in right now. Is that right?
That's your phrase.
Called it.
What would you say?
I mean, I would say that we do see value in bonds here. We're going to look back over a longer term horizon. And we're going to say this was an attractive entry point. You do have to be respectful respectful of the technicals, though. We've been buying on the back up. We paused when things got disorderly, when we broke through 450, because we do want to be aware of what's going on. But valuations are attractive here. This is a good entry point for yield investors.
Have you seen enough in credit yet? We've seen some spread widening. Not enough?
Not enough, particularly in high yield. It just feels perfectly priced for the soft landing. All-in yields are attractive. If that's all you're looking at, high yield at 8 to 9%, that is very compelling, especially versus historic equity market returns. But if you're just looking at it on a spread basis, that spread market is telling you 80%, 90% probability of soft landing, not a lot of cushion for any type of downside risk. And the market, like you said, it's never land out there. We think we can never have a recession, never see growth slow, never see inflation come back to target. And I would challenge those ideas.
Soft landing, hopes and dreams, TK.
That was, so everybody understands, that was an absolute clinic on so many different fronts from Ms. Barrow.
Kelsey, that was awesome. It's good to see you, as always. Coming up a little bit later, Mark Giannoni of Barclays at about 8:30 Eastern Time when we get jobless claims data in the next hour. That data just around the corner, going into payrolls tomorrow. Live from New York City. Good morning.
I am frustrated beyond words. There is this obstacle to governance. You know, we have our disagreements. We differ on issues, but what's happening in the House is just total chaos. We will be moving ahead with the 12 appropriation bills. We have to do our job, and we're going to just let the House hopefully do its part, but we have to move ahead.
That's a struggle right now. That was Senator Richard Blumenthal of Connecticut speaking to Bloomberg's Romaine Bostick and Scarlett Phil on the close yesterday. From New York City this morning, welcome to the programme. The S&P 500 just about unchanged to that line in the sand, just south of it, 0.01% negative. In the bond market, yields are a little bit lower by a couple of basis points. We're back down to 471.44. Some massive ranges in the Treasury market yesterday. On a 30-year, we had a look at 5%, then pulled back. We're back down to about 486. Yields unchanged this morning, Tom. Sparking a move yesterday, the ADP report, downside surprise. The appetite for payrolls tomorrow. Jobless claims coming a little bit later this morning, so another read on the U.S. labour market.
1/4 of Tom Keene, John Ferro, is an island off of Norway, and they came over from Northern Europe and they went to the Midwest. At the time it was called the Northwest, and they went from Western Ohio up through Western Michigan out to Fargo, where Lisa spent some serious time. And it was a whole Germanic and Dutch exit. It's amazing. Like the accents are different.
Right.
Until the 19th century, huge non-use of English. And our next guest is a real Republican from a conservative Dutch part of this United States.
I thought you were saying that I'm 1/4 of Tom Keene.
No, the Hadsel family, which I'm sure Heisinger knows.
I meant intellectually. I didn't mean Bramo. That's rude.
The gentleman rude. From Western Michigan, outside Grand Rapids, on the fields of Michigan, joins us now. Bill Heisinger. Bill, you know, the thing that we've seen for the last 36 hours, I actually thought of you, and that Newt Gingrich has identified it as 4% of GDP. We went from Lincoln, southwest of your family's heritage, to 96% of the GOP in crisis. How do you people get back control of the party? How do you get back control of the narrative?
Yeah, that's a great question. In fact, I happened to see former Speaker Gingrich last night at a dinner. But it is interesting. I do have to comment. You played Senator Blumenthal's quote, and yes, the House is a bit of a mess right now. But I would just point out those who live in glass senates shouldn't throw stones. All right, because they have not done anything when it comes to the appropriations bills until this year, and it was only when the House threatened and really pushed this whole notion that we needed to pass those 12 appropriations bills that they actually passed anything out of committee. So I'm glad to see that people are realizing that these massive Christmas tree omnibus bills are a horrible way of moving forward. But yes, we've got a mess in the House. We can't do anything until we pick a speaker, and hopefully that's going to come sooner rather than later. But I'm not sure that we're there yet.
I look, Congressman, at the joy that America has. That maybe we ought to have some successful small business people in Congress. You're one of them. You're the gravel of Michigan, running gravel, moving it out, building things in that. How do we take advantage in this crisis of a beleaguered small business? I think it's been ignored here for weeks and weeks.
Well, first of all, you got to stop crushing them. And whether it's at local level, state level, I'm a former state legislator. I know what can happen on the regulatory side as well as the tax side, and certainly here at the federal level. That is writ large, but we also know the inflation impact has been massive. And I was interested in hearing, I think it was Kathy, who was on just prior to me, talking about this soft landing, hard landing situation. A lot of us would argue that the Fed was late to the table in starting to move those interest rates up, and now we've been paying a massive price, literally, for that on the way down. But we got to stop this tax and regulatory crushing, plus the rhetoric, right? I mean, it's small business drives the economy in so many places, and a place like Michigan, all right, we're watching the UAW strikes and those kinds of things, but we got to make sure that small businesses.
At least in the news flow we've had, I think this has been way underreported. My anecdotes in New York City, a small business is getting absolutely crushed. There's no other way to put it.
There is a real concern here being pushed and pulled on both the side of inflation, a tight labor market, and also higher rates, so you can't borrow cheaply. But Congressman, I would love your sense, just to build on what you're talking about. Kelsey Barrow was on. She was talking about how a hard landing looks more likely. A lot of people, and I would guess that actually perversely might be a benefit to the U.S. fiscal profile, because that will lead to lower interest expenses. Right now, people are looking at the fact that there is no leader in the House and attributing part of the move in the Treasury market to that, saying that dysfunction in Congress is allowing yields to keep climbing as the fiscal profile of this nation gets called into question. How important is it to you to make sure that there is at least a functioning, at least a cross discussion among representatives?
Yeah, we have to have that. And look, I believe a number of my colleagues, some of them were chasing cameras, others of them had actual policy issues. And they erroneously, in my opinion, thought they would be able to move this process along more effectively and faster by shutting down the government. My experience, both in 2013 with the Obama administration, 2018 going into 2019 with the Trump administration, that isn't the case. So that was bad tactics on that part. But how do we restore confidence? That's a key thing. We've got to get unified and quit the circular firing squad in the House of Representatives. But we do have long-term issues that we have to address. I have a bill that would call for a debt commission, a fiscal commission that is going to look at all of the various trust funds. It would be something that couldn't be amended. It would be forced to have a vote taken both in the House and the Senate. And it allows us to address that 70% of all the federal spending that happens on autopilot. I don't touch it as a member of the House. The senators don't touch it. The White House doesn't do anything with it. It's just on autopilot. And if we don't wrestle that dragon down to the ground and have an open and honest conversation with the American people, then we're going to be in real trouble if we see any of those bond rates continue to go up, because we're knocking on the door of $800 billion in interest alone right now.
Congressman, how much of an obstacle is the former President Trump to getting some sort of real discussion like this put forward, considering the fact that he was one of the people pushing for a shutdown, pushing for basically just make it not happen. Don't pay the bills until you get what you want.
Yeah, well, it's not helpful at the end of the day. Like I said, I think that's an erroneous strategy. It doesn't work. Getting back, though, to that long-term issue, both President Biden and President Trump had said you can't look at some of those massive drivers of our automatic spending. That's a mistake as well. And I'm glad to see we've actually had this bipartisan bill. It was 7 Republicans, 7 Democrats who were the original co-sponsors. It was me as author. to set up this commission. And that ultimately doesn't matter what the politics is trying to dictate out there on either side of the aisle. The realities are what we have to deal with here as policymakers, and I hope my colleagues will step up and actually be policymakers and honest brokers.
Congressman, thanks for your insight this morning, your perspective. Thank you, sir. Congressman Bill Huizenga there of Michigan. TK, your thoughts?
My thoughts is he's a small businessman in Congress. There's not enough of these. This is a guy that actually ran a successful business. How odd, John. How strange.
Be nice to get his thoughts on.
It's a really different thing.
On where he stands on those current strikes in his state as well.
Yeah, the strikes. He's a bit distant from it. This is over in western Michigan. When you fly over, you go into O'Hare. This is that hunk of land you see before Lake Michigan. But, the bottom line is this is part of the Republican Party that's been completely overwhelmed by what we've seen from the former president, from Mr. Gates in his conversation with Balance of Power last night. This is the 96% Newt Gingrich is talking about.
What did he say? If you're in glass senates, don't throw stones or something like that?
Yeah, that was a shot at the senator from Connecticut.
That's a decent line. You would expect that. All very friendly, diplomatic, on the edge of English. Bit of share of Academy
Almost
Securities.
British.
Almost coming up. Although they shout at each other sometimes, which is a little bit too much, but whatever.
Yeah, it's physical over there. I think we'd do better. We would do better. Physical. We would do better if the House of Representatives had the physicality of the House of Commons, where they really go at it.
You want to see more of that?
I'd like to see more of that.
No, I'd actually like to see the president a little bit more engaged as well.
Same thing.
But, that's not happening anytime soon. Equities just about unchanged on the S&P 500. As I said, Peter Cheer of Academy coming up a little bit later. On the bond market, fixed income right now, really the epicenter of our world. Yields lower by a couple of basis points. The 10-year 471.65. Jobless claims just around the corner in the next hour, 34 minutes away, with equities going absolutely nowhere. From New York, this is Bloomberg.
All these negative things that we're talking about, they're right in front of us.
There's really no guarantee that Treasury rates have peaked and are about to go lower.
I think the wake-up call is coming. We're starting to see that in liquidity of credit. It's starting to deteriorate and spreads are widening.
What I worry about is if this sell-off ends up being sustainable.
There's a bar at which the Fed would come in and do something to stabilize markets. That bar is higher because you have this backdrop of inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Quite a day. It's a calmer day, says John Ferro. I don't buy it for a moment. I look at the screen and I see some real history being made. We've talked about it all morning, John. And the important thing is the conversation forward from Fed officials, and I'm going to suggest also from bank managements enjoying this move in the market.
What a different a day makes. Hey, do you want to sing that?
Or 2 days.
Do you want to sing that?
No, I can't sing.
We'll give that a miss. What a difference an ADP report makes. A downside surprise sparking a big bond market rally. So look at the data. Jobless claims coming in 29 minutes' time. Payrolls tomorrow morning. And I think we know the game plan now, Tom. We know what regime we're in. Bad news, slightly bad news, is good news, apparently, because Treasury starts to rally and equities get some relief. We'll see if that sticks.
You get a Hail Mary recovery here in bonds, price up, yield down. Maybe some of the angst goes away, but in those conversations to open this hour and what we've heard today, I thought Kelsey Barrow of J.P. Morgan was just lights out moments ago about what if we don't get...
She was fantastic.
Price up, yield down. What are we doing in November?
She's looking for a rally at the long end. Perhaps this Fed's going too far in their mind. Lots of Fed speak today. Lisa's going to catch up with Mary Daly of the San Francisco Fed. Really looking forward to that. You'll hear from Mester, Kashkari, Barkin and Barr tomorrow. You'll hear from Waller. This from Andrew Hollenhorst, the City. TK, Fed officials won't push back on higher Treasury yields. Are they embracing what we see? Goolsby of Chicago says he's puzzled by it. To Joe Weisenthal and Tracy Alloway on the Odd Lots podcast. I have to admit, I'm struggling to see why he's puzzled by some of it.
To me, it's an academic phrase.
There's a lot of reasons for it.
It's not in his theory books at University of Chicago. But Lisa, what's important here, when I say some mathiness like log convexity, that's a drift function that's under control. In the last 4 days or so, your world has not been under control.
Which I think was interesting that Kelsey Barrow nodded to. And she said, at some point it felt like there was another freight train getting involved that they didn't necessarily want to dive dive into, and that was where the buyer strike comes into play. What that freight train is, though, has yet to be identified. That maybe speaks somewhat to the puzzle, because if you look at, is it a buyer strike that has a more permanent structural kind of implication, or is this sort of a short-term, even the buyers don't want to get in the way of something that is essentially a falling knife until you get catharsis?
For Global Wall Street, we're going to do this quickly here because our next guest is too important. And for those of you that are not part of Global Wall Street, we're going to try to speak in English so you can understand the tension out there. Think 7.88%, 30-year mortgage, John, 2 days in a row.
Equities just about positive. Let's whip through the price action, Tom. The S&P 500 just turning positive moments ago. Yield to lower by a couple of basis points, 471, after thinking about 490 on a 10-year. Only at one point yesterday in the Asian trading session, all the way back down again. We're down by a couple of basis points this morning on a 10-year maturity. On a 2-year, down to 5.02%. So rates were a problem, Tom. Treasuries have started to rally. The dollar was dominant, starting to weaken just a touch against the euro 105. And crude had absolutely exploded higher from the summer and is pulling all the way back down to the low 80s.
I'm sorry, I missed that.
Gasoline demand yesterday, latest figures showed some weakness there.
Yeah.
We were worried about stockpiles, inventories. Maybe they're starting to build again. So a reversal of recent trends. We'll see if that sticks, Tom. One data point, maybe a couple.
Yeah.
But that's the news.
We're going to dive into this now. We're going to do a nerd fest here. And John and Lisa got some smart questions on where we are right now. Joining us, hugely qualified, Peter Shear, head of macro strategy, Academy Securities. He's enjoyed these kind of moves before. Bank of America, before they blew it up. Bob Sinch in foreign exchange, really experienced, and a guy riding a herd, a guy named David Goldman, who was in my book. David Goldman told me once, look at the tranches, and you nail this in your note, and everybody's looking at worry, distress, South African rand, blah, blah, blah. And the David Goldman tranche is the quality stuff up here. You write about previously deemed safe assets. How close are we to those better tranches of credit being previously deemed safe assets?
Yeah, and I've always looked at this world of, you've got high yield and IG, and Treasury's always been that safe asset, super safe, and it feels like something's cracking. I think this time we're going to be okay. I think we're going to get the 10-year back below 440 because we're going to see kind of a really quick gap lower in yields as data comes out weak. But I do think something is cracked. And for the first time in my lifetime, people are actually questioning the trajectory of where treasuries are going to be. And that is very concerning to me because every financial bubble that we've ever had has always come when it's a safe asset that breaks. It's never the risky assets. It's when a safe asset breaks. And we had a whiff of that in the past kind of week or two.
There was a test yesterday, though. And I think the test is always for developed markets. When bad things happen, do we buy treasuries? Something negative happened. We got a soft ADP report for whatever that's worth. We bought treasuries. Isn't that a decent stress test just to understand that if things do go south in the economy, this still works?
I think there's a lot of ebbs and flows. So everyone got so bearish on treasuries. People were piling into it. People have tried to buy treasuries. I've liked them since 425. I liked that 440. So people were very reluctant. So we finally had a bit of that capitulation trade right now. I think as weak data comes out, we're going to see treasury yields go lower. And then we're going to get back to thinking, okay, what is really the long-term trade? And I think that's probably now higher yields.
You think there's a limit to how much bonds can rally, yields can fall on negative data?
I think right now, yes. I think this overlying fear that DC no longer cares about our debt trajectory is problematic. I think if you look at the U.S. as a creditor, we don't seem to care about the debt. We don't seem to even necessarily want to pay the debt. There's all these kind of weird messages coming out of DC, and I think that's going to weigh on the market.
When you said that the longer-term trade is higher yields, how much higher, right? I mean, what are we talking about at a time when you say that something has cracked, that the sell-off that we've seen so far has something sort of damaging inherent in it?
So I think you're right when we were talking about no one could figure out why we kept moving wider every day, right? Yields kept going higher and higher. So there were, I think, a lot of things at motion. You have China no longer buying treasuries. I think you've got our supply issue. The only thing I think that is really going to prevent treasuries from next year breaking about 5% or higher is DC kind of getting its act together, starting to put forward budgets, starting to put forward something that resembles fiscal responsibility. If we don't get that, I think people are losing faith in that, and that's really problematic.
But when you say that basically we're going to get a drift lower, and then when people start to understand that, they're going to go higher again, isn't there sort of a self-limiting feature to this? You said, something cracked in terms of where we were going, the speed we were moving. Aren't we going to get some sort of bigger financial accident, like everyone's been saying, if we lead to, yields of 5% on the 10-year on a persistent basis?
I don't think we get a financial accident necessarily. It depends on how rapid it is. So one, I think we get back to that 440. I don't think we get back to 4% because, like you say, we've had this experience. I think it's a 6-month to a year-long experiment where we start seeing what happens with the election, what the trajectory of the debt is. If people lose faith in that, then I think you go rapidly above 550, you start testing that, and that's where you get the forced selling. The reason I'm always concerned about safe assets is twofold. One, people own them in huge size in their portfolios because they were never worried about losses. If you start worrying about losses, that causes forced selling. And the other part is, what does the banking system own a lot of? And if the banking system, which is always levered, owns a lot of treasuries, and you see this never-ending push to yields higher, I think you see some forced selling and risk management there. So I don't think we're there yet, but I think that's the trigger that we've kind of got just a sniff of this time around. And go back even with housing, right? We had housing bubble, it's broke a little bit in early 2007, late 2007. The ultimate problem didn't hit until 2008.
Pete, you're making me want to just go and hide under a rock. What on earth do I own, if that's your outlook?
So for now, I'm actually bullish, bizarrely enough, right? I do think we're going to get this weak economic data. I think oil was way overdone. I think we're going to get this relief trade. Okay, there's not this inflation pressure. Yields start drifting back to 440. We send stocks higher. Everyone's underweight again. So we have to suck out that kind of pessimism. Then once everyone gets bullish again, then I can get really bearish in positioning.
Okay, wait, but what are you talking about? Are you basically saying that there is a bubble in treasuries that's going to burst with catastrophic implications, to build on what John was talking about?
I don't know if it will or not, but that's all of a sudden became awareness of everyone. And DC can fix this, right? DC can get its act together. I just think everyone's kind of grimacing because no one really believes DC is going to get its act together. But I think that's really the hope, is something comes through and DC starts going back to the days where you run a budget deficit when times are tough, but when times are good, you try and cut it back.
Let's finish here. What does this mean for portfolio construction? A lot of people listening might sit down with a financial advisor and they give them the same old spiel. What we're going to do is split up this portfolio 60-40, and they're going to go on to explain why. Doesn't that all go out the window?
I think you have to be very careful, and you're looking for constantly risk management, right? What looks overdone, what doesn't look overdone. The 2-year seems safe, but I think there's no value in the 2-year. At 490, there was a lot of value in the 10-year. I think down at 440, you want to expose that. But as your yields start shrinking and getting to these narrow ends of the range, take some off, take some bets there. I think you want to expose yourself to equity risk right now. You really start making sure those exposures, where do you want to be in the world? And I think outside the U.S. could be interesting. I continue to look at emerging markets. I think you see a lot of trends there that are beneficial for emerging markets over U.S.
There is acclaimed, and he wrote a great one-volume on financial history, Chris Wayland, our Christopher Wayland. And he had a note last night which goes to the heart of the bid walking away in fixed income. It's the Wayland silence. And that is, you've got a piece to sell, and you get on the phone, and there's nobody on the other side of the transaction. How close are we to the Wayland silence?
I think we had, again, whiffs of that, right? The Treasury market.
Perfect.
And that's all we've had so far. And I think, though, across all assets, you look at what's going on with oil. We've gone to this electronic algo-driven trading. So I think there's this perception of liquidity, and there's no depth of liquidity. So the ability for markets to move very quickly is very high because we have this fake or faux liquidity where everyone's scrambling around trying to make their penny or eighth of a point. And the reality is big moves push us very quickly.
Bottle it.
Clinic, a big what if, a lot of worries for a lot of people who might be listening to some of this, Peter, but ultimately buy risk in the short term, right?
Buy risk in the short term.
Load the boat.
But I would say this does remind me a bit when I was trading the credit derivative indices back in 2007, where you would just gap. You would go from 60 basis points to 68 basis points, no UI, and then you look and you trade it around 68. And that's the sort of moves I think we've been getting in these markets, whether it's oil, whether it's trades. You get these gap moves, you air pocket, everyone tries to make some semblance of it. But
is this one-day option thing, is that the new portfolio insurance?
People are definitely pushing on that, and I think it's the opposite of portfolio insurance. I think it's used heavily to drive markets, push gamma trades, and I think everyone forgets that it can be used on the downside just as easily as it is in the upside. This isn't like some of the other trades, which were bullish only, like we saw with the ape stocks. This is really the ability to push direction, and I think they can lean on markets down as easily as up.
Pete, this was great. Always walk away from our conversations with tons to think about. Peter Chair of Academy Securities. If you are just joining us, welcome to the program. The S&P 500 almost totally unchanged on the S&P. We're negative here by 0.02%. Coming up a little bit later, Mark Giannone of Barclays reacting to the jobless claims data. That claims data has been rock solid. The previous read was 204,000. The estimate this morning, Bramo, 210. I believe the 4-week average is the lowest since February. It's been pretty impressive, that labour market. And the one thing that stands out, I think, in the last week, because otherwise the data was pretty decent, I don't buy into the idea that services was weak. I know there was some sub-indices that were a little bit softer, but overall,
future orders
still in the 50s, aren't we? Still doing okay.
And it still came in higher than expected. Yes, it's decelerating, but not as much and as quickly as people were previously saying, at least in a headline figure. I am wondering, I'm just trying to wrap my head around what some of the things that Peter Scheer was talking about with respect to a potential bubble in the safest assets. What if the real economy doesn't ever notice? What if it basically corrects itself quickly enough that the lag effects never take effect? I mean, this is sort of what people have been betting on. This is how unused to the environment that we're in right now people are.
After listening to Pete, I still can't decide if I should buy stocks or hide. It's like one or the other.
When he and I used to have conversations back in the day, we might as well have just been sitting on,
I can only imagine.
It's like, oh no, gloom, doom.
We should find those old IBs of you two just winding each other up.
It was really fun.
Kevin Tynan of Bloomberg Intelligence joining us very shortly from New York City. Your equity market, just about negative on the S&P. No real drama here. Tons of drama in this bond market over the last month or so. 471.85 on a 10-year. Yields lower by a single basis point. Jobless claims about 20 minutes away.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
They've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs. And so I think they're joining the crowd in terms of selling. And, we're seeing a little bit of an oversold market here headed to 5%.
A man who has seen it all, Bill Gross, the PIMCO co-founder, speaking with Kelly Greifeld and Romain Bostic on a close yesterday, talking about a bond market that's seen some big moves, treasuries aggressively lower. The yield's much, much higher. We back away from those levels this morning. We look like this. A 10-year yield down a single basis point, 471.85. The 30-year did breach that 5% level yesterday. It's come all the way back down, Tom. Your 30-year right now, 486. I think you can call that 487.
Yeah, we're watching it. I mean, the 2-10 spread hasn't given up disinversion. I expected it to be down 1 or 2 basis points, and there's not. You're right. It's calmer, John, but it's not a correlated calmer. It's not a confirming calmer. Maybe we see that with good data here. What, in 12 minutes?
Claims and then payrolls, the big one tomorrow.
So we'll see. We're going to keep you abreast of that, folks, and try to give you the best conversation we can. Kevin Tynan joined us here. What's important about our senior automobiles analyst for Bloomberg Intelligence, and he's kept count. He's got a wood mark in his garage, folks, of the number of times he's put the screw down the Chrysler distributor when he's changing the plugs. Kevin Tynan, the real thing in the auto. Kevin, I've been dying to ask you, and it's in the zeitgeist, when are we done buying $100,000 EV vehicles that weigh the size of a Hummer H2? When does that party end?
I think very soon. Well, I looked at it and, look, the production launch and the new EVs coming out are set through 2024 and probably beyond. But I think what you're going to get as an inflection point is if the automakers don't start to see real demand and real profitability in that drivetrain type, I think you're going to start to see by 2025, 26, and plans beyond that start to shift to something a little bit more practical. And we've been saying that might be the plug-in hybrid makes a reemergence, with battery technology. Maybe that's a 50 to 100 mile range in electric with the, range extending internal combustion or hybrid engine on top of it, so you're talking about 400 miles of range without the anxiety of where to charge or this charging infrastructure that isn't quite ready.
I got 8 more questions on this, but I believe Lisa, help me here. There's a strike still going on?
Yes.
It's just been buried by the news. I mean, there's no other way to put it. What's the new on the UAW strike?
Yeah, look, from my view, I think what you're going to get is a big number for the UAW, but not a whole lot else. And I think that's probably what the issues are. the automakers can't hide their profitability over the past 10 years, and this mix shift to truck from car has been very profitable for them, and everybody sees it, right? But at the same time, they've done that with fewer units. So I think on the one hand, the manufacturers are saying, okay, we can give you a share of those profits, but we can't guarantee that we're going to be growing in size. And I think what a big number does, whether it's a 30% or somewhere in that ballpark, what it does, it also enables the union to go and show that contract to some of the non-union, whether it's pure play EV manufacturers or transplants in the US that are operating with non-union labor, to say, look what we did for our membership. Because at the end of the day, if the UAW wants to increase its member base, they can't keep going back to GM, Ford, and Stellantis. They're not growing in that way, right? So if this is about increasing your membership for the UAW, you're going to have to go knock on some other doors. And I think a backhanded way that the legacy automakers, the domestic Ford, GM, and Stellantis brands can do it is to say, here's your big number, but we got to have the flexibility to get out of some capacity going forward. But go show this to some of those other plants and see what they say.
Kevin, we're getting some sense from the auto manufacturers of just how much the strikes have been costing them. General Motors came out yesterday and said it already has cost them about $200 million since the strike began. We've heard from Ford talking about the F-150 deliveries and how much they've been plunging on the heels of a number of shuttering factories. I'm just wondering at what point we can expect this to precede price rises in some of the cars that they deliver, with the justification that really they've got to compensate for these costs.
Yeah, and look, that production is not necessarily all lost. It'll shift to the next quarter or into 2024. But it's exactly that. And this is what we've seen. And it didn't really start just with production disruptions during the pandemic. The automakers have been moving to this smaller model, more trucks, higher transaction prices, fewer units. So it isn't so much about scale anymore. And this is another part of that, where there's inventory on the ground, probably not quite enough, but ultimately all it does is firm up prices, and the increased cost, although maybe the labor portion of cost of goods going forward is minimal after the contract, but at the end of the day, it's going to remove affordability from the consumer, right? Because automakers are going to have to continue to keep supply and demand tight and move up market to be profitable on the operation. So that's really going to hurt the consumer at the end of the day.
Kevin, I was reading about BYD, which is becoming the biggest electric vehicle maker in China. And I was reading about how they grew up out of first imitating Toyota and then becoming so efficient that even Toyota was trying to understand exactly how they were doing it. How does the U.S. compete with China, all things being equal, without tariffs, without some other guards between the two industries, if there's a very different playing field?
Yeah, it's going to be very difficult. Look, though, the macroeconomic, the government influence varies region by region. So the subsidies that you had in BYD, back in the day, that's a company that was, direct subsidy from the government was well over $1 billion, probably over $40,000 per vehicle. We won't do that here. It'll be difficult to keep them out. And the other thing I think that's going to happen is if we're going to get a rush of Chinese-built EVs in this country, they're going to go directly to the dealer network, where we have this sort of perception now that the direct sales model, what Tesla does or Rivian and Lucid, is the way to go. I think those companies are going to achieve immediate distribution scale by going to the dealer base and saying, like, will you sell our product, as opposed to trying to deliver it directly to the consumer, which has issues with when you get paid for those vehicles, right? You can't book that revenue till you deliver them, but if you deliver them to the dealership, you can, right? So your gross margin stays firm, and you have instant scale in terms of distribution. So it could happen very quickly, although there's still a lot of hurdles to get over for really China small manufacturers or EV manufacturers to get into this country.
Hey, Kevin, just to wrap things up, I know we touched on this briefly, but what are the odds that some of these manufacturers just don't get this transition done? They look into the future and they throw in the towel and say, this isn't going to happen.
Yeah, and look, I don't know that's not a binary bet of bankruptcy or not bankruptcy, or you exist or you don't exist.
Oh, absolutely.
There's certainly a scenario where, legacy automakers or global automakers leave that drivetrain business to the niche manufacturers, to Tesla, and it's a smaller part of the market, certainly here, but maybe in other countries. And what you can get is to say, and Toyota's been saying this the whole time, is there needs to be options, right? So internal combustion will work in some regions or for some people, so will plug-in hybrids, so will gas hybrids, so will electric. Maybe hydrogen is an option too. So I think that if it's about climate, right, there needs to be options. If it's about capitalism, that gets a little
precisely.
bit...
Kevin, you know where I'm going with this. If it's about climate, it's not about massive SUVs that just happen to be electric. Let's face it.
So it's not about climate.
Precisely. Kevin Steiner, thank you, sir, of Bloomberg Intelligence. If it was about climate, it wouldn't be about that at all, would it?
Right.
You can't conflate the two things.
You know where I am on this.
We're both on the same page.
And Lisa mentioned this, John, and this goes to the United Kingdom. A headline: BYD ADL to supply 130 electric buses for Coventry. It's just as simple as this. China's out front. We're playing catch up.
Big time. Next hour, Joanne Feeney of Advisors Capital Management, Chris Mamani of Lafayette, and on the bond market, don't miss this. Next hour, Mark Kiesel, PIMCO, coming right up.
Bloomberg surveillance, Lisa Abramowicz looking at the bid on bonds. I guess it's stable. Here we are seconds before this economic data, Lisa. What do you think? Bonds up? Price up? Yield down?
If there is a disappointment, say an increase in jobless claims, that is the expectation that there will be some sort of firming up of the bid. But how big does that surprise have to be, Tom? And that, I think, is what we're going to see.
It's a thin set of data today, but an important set. Trade balance, ancient data. McKee will discuss that, but clearly everyone claiming to focus on claims. Michael McKee, thumb up, thumb down for bonds.
I guess at this point it would be thumbs down for bonds because the numbers don't really move that much. 207,000 jobless claims filed last week. This is not what we were really expecting. We thought the auto workers might start to show up in these numbers. 204,000 was the initially reported number in the prior week. The continuing claims numbers also lower, at least compared with the previous issue, 1,664,000 compared to 1,670,000. So it's kind of interesting to see that what we're getting here is a still tight labor market, even though we've got people on strike who make other people eligible for jobless claims when we thought they'd go up. That didn't really happen. Tom, you mentioned trade. Trade balance comes in lower than it had been expected and lower than it was the prior month, $58.3 billion, down from $64.7, and that is going to be something that contributes to third quarter growth as well. These are August numbers. So now the revisions are in for jobless claims, only up 1,000 last week to 205. So 207 is hardly any change at all. And it looks at this point like the labor market's not getting a break, and your bond trader friends are not getting
We're going to do a bond trader Bramo data check here. Really, really important. Equity's a little bit soft, but Lisa, I went right to the 10-year real yield, 2.41%. Not out to new highs in the inflation-adjusted yield, but, teens-weens away. This is something... Am I right? Price down, yield up is just a good generalization?
I mean, we are moving up just a couple of basis points, 4.74 now on the 10-year yields. And we're watching this across the yield curve. And it goes to a guest earlier in the show that the entire yield curve is moving in tandem as people try to reset to understand what the new normal is. But I will say these are incremental data shifts relative to what we were expecting. The fact that we're seeing movement on this at all gives you a sense of just how jumpy everybody is trying to understand where the economy is, what narrative is going to prevail, and what exactly is driving the bond market.
I mean, here we are, and I guess it's not as a break point, but as John mentioned throughout the entire morning, it's been a calming in the market. Is this data that will uncalm Fed speakers, Mike McKee?
I don't think so. The Fed
Are they going to stay puzzled like Goolsby?
Well, remember, the Fed has expected unemployment to come down from its initial forecast, or its June forecast in the September SEP. So they're not going to be surprised. And the story would seem to be, if the bond market wants to propose a recession is imminent, that people want to hold on to workers. And that's the story that we have been seeing, these labor hoarding numbers. We did see Michigan and Ohio jobless claims rise among the largest increases with over 1,000 each, but that's not a whole lot.
Just question, though, on ADP, because a lot of people dismiss it as irrelevant as soon as it comes out and moves markets. I am curious whether people have changed their expectations for tomorrow's print based on what we've seen from ADP.
Well, this is kind of fascinating. The ADP number would suggest perhaps a weak number because they have come in above the private sector hiring for the last 5 months. But the whisper number has gone up. The Bloomberg survey sees 170,000 jobs created, and the whisper number is 180 at this point. So
Okay.
The market seems to think we're going to get a stronger than expected number.
You going to be with us tomorrow? You're not going out
If
to
you'd like,
Broncos?
I mean,
Yeah.
I don't know. Jobs days usually kind of slow.
It's the Super Bowl.
In the markets, yeah.
It's a Super Bowl. Michael McKee with us tomorrow for the Jobs Day Super Bowl. Looking forward to that. We'll go beneath the headline data at 8:30. There is a book. It is 800 plus pages. Everyone owns it. No one's ever read it, I should say, except he lived it. Michael Woodford, 20 years ago, in 2003, wrote a definitive book called Interest in Prices. Mark Giannini of Barclays, their chief U.S. economist, had the toughest job in academics. He was the assistant to Michael Woodford. You had to actually read Interest in Prices, right?
Yes, I did.
You had to teach Interest in Prices.
As well, yeah.
Is this economy, are these dynamics identified by the Euler functions, the classic Woodford advanced mathematics, the dynamics of that classic textbook, is any of this economy in that textbook?
I think this textbook and the model that it develops there is really central to understanding what's going on in the economy.
In what way is it right now?
I think it's a lot of what's affecting the economy and the way monetary policy affects the economy in particular is through the communication, through what the Fed is intending to do in the future. I think this book in particular develops a whole theory, a full understanding of how communication, how the forward guidance that the Federal Reserve puts out is transmitted through the bond markets, through the longer-term rates, and how it's transmitted as well through the economy.
Just because of time, and I've got to go just simply to this, and the word optimal, folks, figures into this thinking. It's critical. What is the optimal Fed communication strategy now to get to a constructive outcome?
I think optimal policy would be one where policy is indicating really a tight policy stance until it's absolutely clear that we are returning to a 2% inflation target.
So just to build then on what Kelsey Barrow was saying, she said that we are going to have a hard landing and the Fed will be the last to admit it. Is that what you're saying as well, that essentially the Fed's going to need to see a hard landing in order to come in and actually make a shift?
I think the Fed is going to be slow in cutting rate. I think they have indicated really clearly that they want to maintain rates elevated for a long time, to be really clear, really sure and confident that inflation is returning back to the 2% target. So I think a mild slowdown in the economy might not lead them, as they have in the past, to really cut rates abruptly. Now, if we have a very hard landing or really a deep recession, then of course they would respond to that.
How much more likely, in your view, is a hard landing or a more punitive recession, given where we've seen yields go, given the long end and how much we've seen that move?
Yeah. So I think there's a huge amount of momentum in the economy, and we've seen the latest data on consumption, on initial claims this morning again, showing really the labor market is tight, consumer is really, really strong, and that provides still a lot of momentum to demand in the economy. With yields moving up as they have in recent weeks, I think that's pricing on the brakes, that's slowing down the economy. But this is coming in tandem with stronger data as well. So I don't expect at this point really a hard landing. We expect really a bumpy landing, so we are a little more pessimistic at Barclays than the Fed is for next year, but not a deep recession.
To Woodford's book, Olivier Blanchard, when he reviewed the book, he called it an immediate classic. He went back to pre-World War II and Patinkin and said that the idea, the intellectual lift here was profound. All that's great, except Blanchard wrote in my book of the summer, a small monograph on fiscal policy and its link into economics. Olivier wrote that there's other factors out there. Do you at Barclays see other factors like technology, whole different sets of international systems that make traditional economics non-operative?
So I think from a conceptual standpoint, I don't think things have changed dramatically. I think from the reality in which we are, the factors have changed. So the technology, of course, shows some promises. It's yet to be seen when it's going to show up in higher productivity numbers. I don't think we're seeing that yet, and it's probably going to take a long time until we see that.
Right, when you start sweating, as you did at the Swiss National Bank years ago, you dial 1-800-AJ Rajadox. You've got a bond genius at Barclays and AJ Rajadox. What do you and he think about price down in we moved from a log convexity, a stable drift function, to a free fall in bonds in the last number of days? How do you and AJ fold that in together?
So I think with AJ, with our rate strategist and Shoal Pratt, and we're talking a lot about the stance of policy and the expectation that the Fed is going to remain tight for some time in 2024. We don't expect any rate cuts, at least any time before September, and then we expect rates to over the longer term to not return back to the, in real terms, 0.5% that we had before. So something probably more elevated, closer to 1% longer term real rate. Add to that about 2% inflation, and you are easily at 3% nominal rate, 3.5% nominal rate. Add some term premium to that, and it looks like the 4.6 or 4.7% on yields is not necessarily stretched.
How much is this sustainable by the power that some people have said labor has gotten when it comes to negotiating wages? And I say this heading into tomorrow's jobs number after seeing that layoffs just aren't happening, even as you see these real pressures building on both sides.
Right. So I think the labor market is still tight, as I mentioned. I think the JOLTS data that we got earlier this week show that job openings are still very elevated. Over 9 million job opening. I think there is a lot of pressure on the part of the workers to raise wages, to push firms to accept higher wages. And we see our estimates of underlying wage growth is running at around like 4.3%, which we think is higher than what's consistent with a 2% inflation.
So in other words, do you see that 4.3% hourly wage gain to be something that we could see in perpetuity and that would lead to a higher inflation rate? Or do you think that that's something that has to come down?
This is something that will come down as the Fed tries to bring inflation down. And in order to bring inflation down, we'll need to engineer some slowdown in the economy. So when that slowdown takes place, we'll see firms hiring fewer workers. We'll see this hiring rate come down, the job openings rate come down, and people will no longer be able to press for rapid wage rates.
Stay with us. This is too important a conversation. Lisa and I have to look at the markets moving here off of what we saw with the benevolent claims report. Lisa, up 3 basis points a 10-year. Could we revisit 5% on the 30-year piece?
I mean, given how quickly and how volatile these markets have been, who knows? What I am seeing right now is a more material increase in yield priced down as people digest some of the data. The fact that we keep getting stronger than expected labor market data offsets some of the gloom and doom that people have regarding what higher yields can do to the economy longer term.
The VIX 18.84, not out near that 20 level of a number of hours, days ago, 2.43% on the 10-year, 2 basis points away from a new high on the real yield. The Standard & Poor's 500, negative 17 points, down 0.4%.
We're speaking with Mark Giannani of Barclays about the strength in the economy despite what we have experienced with respect to rates, which, Tom, to me, really raises this question, what is the breaking point, right? Can we engineer, and is this something that's sustainable despite the way that we've arranged the balance sheets in the face of
Ask at the Mary Daly at the Economic Club in New York, because that's right where I wanted to go. Mark, this is so important. Take the mathematics of modern science, Clarida, DSG, Gertler, what you did with Mark at Princeton and all the mumbo jumbo we've been talking about, bring it over to a standard Hicksian structure of the real economy. If we stay higher for longer, as you submit, what happens to the zombie companies developed over the last 16 years?
Well, a lot of companies will need to adjust to a reality of higher rates, and I guess that's they're going to try to stay in place for as long as they can, and at some point we'll see probably more failures. We'll see more restructuring taking place in the economy, and I would say that's a pretty standard transmission, unfortunately, transmission mechanism of monetary policy. When you keep rates higher and you try to slow demand, eventually the labor market cools and firms have to shrink.
And I lied to Mark. Now that I've lied to Michael. Now that you've been here, do I have to read interest and prices?
Of course.
All 880 pages?
Of course, all of them.
Go away. Dr. Giannani is with Barclays in Princeton, I should say, as well. Lisa, I'm sorry, we're talking fancy economics here. Nobody watching or listening is worried about 800 pages of Michael Woodford. They're looking at these markets.
They're looking at these markets and trying to understand how sustainable these are. If nothing breaks, is this the new normal? And then what does that mean in terms of what the capital structure is and the cost of it going forward?
2's10 spread, under 30 basis points. Disinversion continues. This is Bloomberg. Good morning.
The dots at the September meeting had 12 of the 19 participants, indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, if even some of this recent increase were to stick, I think the Fed could well be done.
That was former Fed Vice Chair Richard Clarida speaking about how his view would have changed if he were still on the Fed, Tom, taking a look at the bond market and how that influences whether to hike or not.
He's showing some courage here. He's out front on this debate. Do we need to go back to 2%, as we just heard from Dr. Giannani of Barclays? And I have Richard Clarida in a panel. He and I are doing a one-on-one late October. I can't wait for it to talk to him about the market outcomes if we get a new level of interest rates.
The pressure on whether to allow the economy to sort of go along, even if it means at a 2-point-something inflation rate. I wanted to take a look at the bank stocks because you were talking about them this morning, as well as John, about how much they have been underperforming. And in the past 2 months, just to give you a sense of the degree to which there has been underperformance, JP Morgan shares down more than 8%, Citi shares down almost 13%, Bank of America 17% decline, and Goldman Sachs down almost 13%. A big question here about why. Is this simply a profitability question, or is this something more fundamental that has to do also with businesses slowing down and potential risk in some of the most stalwart types of assets, right? I mean, that's something we've been talking about, Tom, and you've been talking about it really aggressively, about the implication for banks if you have such a massive sell-off in one of their ballasts of treasuries.
Yeah, I mean, it's there. And to your point, is it a real economy analysis? I get that. Like, are we going to make money? Are we not? Allison Williams has been brilliant on this, among others. But I'm beyond that. I'm to standard deviation moves in bonds, not to be inflammatory, but just to at least identify price. Bloomberg with a wonderful article today that is completely price-based, not yield-based.
This was something that came up back in March, where you had banks come out and show real risk tied to risk-free assets. But then there was this Fed facility that kind of stepped in, and how much that stave off any distress from these losses. Joining us now to really understand the losses, Sri Natarajan, who covers all things banking for us here at Bloomberg, and really has dug deep into the structure. I just want to start with, in all of your conversations with all of these bankers, are they indicating any real stress that is making them truly concerned about another crisis?
They're extremely cautious. No one will talk of stress, but they are extremely cautious. And what if I tell you that the list of banks that you just put up are actually some of the better performing banks this year? When you take one step lower, you go to the regional banks, they are getting hammered. We just had a story out today looking at the shorts on a lot of those names. It is the short interest in those names at a higher level today than it was in March. That is certainly a sign. March was a tough time for many of these banks. So I want to take you back to something you said this morning, Lisa. You talked about the phrase narrative roulette in markets. I'd argue when it comes to banks, there's been narrative hibernation. They were facing severe problems. The Fed stepped in with a solution patch, but the problems didn't necessarily go away. And it's becoming increasingly increasingly clear that with every whimper and howl in markets, the Fed is not going to come back rushing to the aid of these banks. So their problems are very real. We have a lot of analysts saying that treasury markets need to stabilize for these bank stocks to stabilize. Fine. But what would cause those treasuries to stabilize right now? An indication of a cooling of economic growth. And that can't be good news for banks, especially regional banks that are a great proxy for the economy.
I take your narrative hibernation concept that people just have this concern about crisis ongoing in their memories. At the same time, how much of the price declines have been, I don't want to say justified, but understood also in the lens of just M&A activity is coming down, loan activity is coming down, the actual loans they have, you've got delinquencies going up, and then you've got portfolios of treasuries that are losing value. Does that justify some of the moves in and of themselves without any kind of massive collapse that would warrant some additional rescue?
Big factor. The 500-pound banks, the large banks, the big banks, they are, of course, impacted by when will capital markets return. It isn't so much about M&A markets coming down or not enough capital markets activity happening. That's been the case for the last 18 months. But at this point, we were starting to hope that these green shoots will start to blossom into something more. That's not happening. That's getting pushed out. What's happening in Washington is not helping with that. Meanwhile, the challenges for the regional banks are very real and remain in place. They still have that deposit cost pressure. They're still stuck with a lot of the loans that they made when interest rates were at rock bottom levels and no easy way to get out of them. So with these treasury moves, that's not going to aid them either.
James Dimon, after he runs around Central Park, is going to go back to his house, his abode, and he's not going to dial Sri Natarajan to say, hey, Sri, let's do that interview you've been asking for. He's going to call Ashley Bacon, most important person on the planet, the chief risk officer at JP Morgan. We did this with Kelsey Barrow of JP Morgan half an hour ago. Explain to me these bond losses that I'm seeing in mark-to-market. You can't tell me they can cover this up.
Jamie Dimon is actually a very good name to talk about that, because the big challenge, and I'll take you one step next to Jamie Dimon, and that's Brian Moynihan. That stock was down 25% last year, is down another 22% this year, and that is one of the names when they had a big amount of deposit inflows.
We're going to rip up the script here right now. Folks, Natarajan yesterday put this out. JP Morgan, 15% higher than Bank of America. Now the spread's widened out. What's the problem at Bank of America?
Yeah, JP Morgan, the number one bank in the country, is now double the size of Bank of America. Bank of America plowed a lot of its portfolio into treasuries that are yielding 2.5%. Meanwhile, when treasuries shoot out to 4%, 4.5%, 5%, possibly 6% and 7%, that's a big problem. That's not good news for Bank of America. That's not necessarily turning into any sort of realized losses, but it is certainly weighing on investors who are worried that Bank of America is not doing enough with what it has.
Calendar item, October 17th. Moynihan's got to go mark to market or else.
Well, and he has to explain where he's going to get the capital to then do additional lending to capture some of these higher yields. John's asked this question a lot. Have we reached the point, and with the rapidity of which yields have risen, where the yield space is actually a negative for the foreseeable future for some of these banks?
It certainly feels that way, only because of what, let's look at what Ken Griffin said a few weeks ago, I think, when he talked about this idea that it takes about 2 to 3 years for real rates to work their way through the real economy. The rate hike cycle started in March 2022. We're 18 months into that. This is when the pain will be felt in the real economy. A lot of the big banks are still saying that they're not seeing stress with the consumer. I don't know how much of a factor is also that they have upgraded with the kind of market that they continue to bank. So in their segment, they necessarily are not seeing the first signs of stress as they used to 30, 40, 50 years ago. But there is undoubtedly some stress developing in the consumer economy, in auto loans, in lending, and that will start to impact these banks.
Of course, the pristine customer isn't going to necessarily want to borrow at 10% rates, which is part of the issue also with loan volumes. As they have constrained capital to go out and lend, how much is private equity, private debt, the rest of the private markets complex eating their lunch?
Oh, they're absolutely licking their chops. They want to go out there and find the right opportunities. To some extent, the banks, the smaller banks especially, don't want to offload some of the loans that they've made because it almost feels like a fire sale. But a lot of these private credit shops, a lot of these private equity firms are going to be out there trying to grab a share of the traditional banking market. Okay. And they will be successful because they have a lot of capital to put to work and a lot of time on their side.
1987, I was instructed on what portfolio insurance was. It was an ugly afternoon. I remember people literally in tears on the trading floor. And every time we come around, there's a shadow out there that we don't see coming. I don't need Nataraj and gloom, but what is the identifiable shadows right now for the Ashley Bacons of the banking world?
I don't think it's so much the identifiable shadows as what's visible in absolute sunlight, which is activity is not picking up. The big ballast for the consumer banks is their investment bank. You're not seeing a lot of activity there. Everyone's talking about uncertain forward for the consumer economy, for the real economy.
So you're going to go the real economy away from what Lisa and I are seeing in the carnage here?
Well, all I'm saying is when you don't have one side of the firm firing on all cylinders, no real sign that the other side, the Wall Street operations, are going to do it for them, then there is really no great narrative to say these bank stocks are going to do really well in the next few months.
Lisa, I'm going to get 28 basis points on disinversion. We've gone from, again, I call it the Priya-Misra 100 basis points, and we've disinverted. We're going to get to a negative 28 basis points here in 2 cups of Sri coffee.
And typically that is when trouble ensues. Sri Natarajan, thank you so much. We really appreciate you being with us. I will say, as we see the moves in the market, this has been one of the question marks. When does something break? It seems like the insulation in the banking system, Tom, has at least removed that from being the circuit breaker that some people saw back in March.
It's going to be interesting to see. Highlight, particularly with these markets moving, wait an hour, Lisa Abramowicz in conversation with the president of the San Francisco Fed. This is really timely. Mary Daly is truly one of my favorite people within the racket. 12 noon today, the Economic Club of New York, Bramo and Mary Daly. Thank you so much to our team for great conversation today.